committee decided to maintain the target range for the Fed funds rate in support of the Fed's dual mandate.
This was a very deliberate and patient approach, and we'll see through the path of incoming data how this plays out.
It's hard not to interpret that as a little bit more hawkish than otherwise people might have expected.
Half of the committee is expecting rate hikes this year. We were thinking 2, maybe 3 to be decorative. We didn't think half the committee.
That's one of the challenges the Fed faces, is they've got to manage to the economic aggregates when the devil is in the details.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning, live from New York. Welcome to Bloomberg Surveillance. It's Tug of War Thursday with two competing factors buffeting markets. On one side, stocks rising on the prospect of a signed deal between the U.S. and Iran. On the other, a bold new Fed chair putting a hawkish stamp on the world's most important central bank, locking in market expectations for a rate hike as soon as October. For the moment, however, traders taking more signal from falling oil prices than potential rate hikes.
And you have gasoline this morning in America falling below $4 a gallon. So that's a big deal for this White House and, of course, this market. You see, with the signing of the Memorandum of Understanding last night by the President of the United States at the Palace of Versailles, you see oil falling lower and an uptick in traffic already, almost immediately in the Strait of Hormuz. Now, we know potentially there's going to be issues down the road when it comes to this deal, and there's a lot to be negotiated. And not all of the president's red lines, or most of them actually, not even hit. But the fact of the matter, to this market, more barrels are going to be available.
Yeah, to your point, we are hearing about the first Saudi tankers traversing the Strait of Hormuz with their transponders on. This highlighting just how much more traffic could potentially go through. There are a lot of details. We don't know whether this was part of the agreement or not, or who else might be going through the Strait of Hormuz. But this is what markets are looking for. And this comes despite this new focus by the Fed on bringing inflation down without much mention at all of the employment market.
A minimalist approach now from this Federal Reserve. A very short statement, the word count much lower. You had a short press conference, and you had a Kevin Warsh that decided to not put a dot on the plot, not submit a forecast. This is an individual who is going to start a really brand new era of the Fed, and also a lot of emphasis, Lisa, and I'm sure because you did a fantastic job yesterday on the Fed special, a lot of emphasis on these special committees that are going to look into different parts of how the Fed operates, like communications, inflation, the balance sheet, etc. And maybe that was a punt for the Federal Reserve chair, but definitely getting his feet wet and saying, you know, we're going to need some help when it comes to some of these issues.
Well, there's some real meat behind these task forces. I went home last night and I said, okay, we're going to have a task force about dishes. But there is a sense right now, these 5 different task forces are getting assembled right now. And going forward, they are expected to come to some conclusions by the end of this year. Right now, you bleed it all through the markets. Yesterday, real risk-off tone heading into the close when it came in particular to bond-sensitive sectors. Today, we're pulling that back. S&P futures up 0.9%. The tech-sensitive sectors of the market are gaining that much more. You're seeing dollar strength continue. This was a big story yesterday, particularly with the Bank of Japan and what the yen is doing. Today, you're seeing that continue versus the euro, 114.73, the euro dollar cross. You're seeing yields come in just a bit after surging yesterday. Watch the front end of the yield. You saw that rise 14 basis points on the day, and crude solidly lower, $74.58 on WTI. Coming up this hour, Ed Yardeni of Yardeni Research and Kevin Warsh's hawkish debut. Norman Roule of CSIS breaking down the interim deal to end the U.S. war with Iran, and Jennifer Huddleston of the Cato Institute as AI leaders make their case at G7. We begin this hour with stocks rising and bond yields falling after Kevin Warsh made it clear the central bank will not tolerate high inflation. Ed Yardeni of Yardeni Research calling Warsh a, quote, hawk in dove's clothing, writing, we thought he was a dove who favored lowering the federal funds rate. Instead, he hammered home a strict orthodox message on inflation with a strong commitment to price stability. Ed joins us now for more. Ed, great to see you. Thank you for being here. So is this more of an Alan Greenspan rather than, say, an Alan Burns?
I really can't answer that because I have a task force working on that.
Don't we all?
It's very Greenspan. I mean, it's, you know, not a lot of information, a lot of ambiguity, and, you know, occasionally some surprises. He started right off the bat with a surprise. You know, it's kind of like he had an interview with President Trump and yesed him, told him everything that he wanted. Yes, we're going to lower interest rates. Yes, AI is creating productivity. Then as soon as he got the job, it's like the old Warsh concerned about price stability. He mentioned price stability over and over again. And not only that, but he pretty much committed to 2%. He didn't finagle that too much at all.
Mike Reed of RBC said, by their count, inflation was mentioned by Kevin Warsh 19 times compared to 4 times where he mentioned the labor market.
Right.
Is this...
And the labor market's looking good.
Right, exactly. There was no mention of dual mandate or a sense that maybe there's some weakness there in conflict in the dual mandate. Is this all talk and not action, right? I mean, if you were skeptical, you would say this is somebody who wants to jawbone the market.
Yeah.
You're seeing the move that he wanted in the flattening of the yield curve. Yeah. And then he won't necessarily
deliver. I think he's hoping that he'll be lucky because so far so good. I mean, the price of oil's coming down. As you mentioned, the price of gasoline's coming down. We are going to see the headline inflation news coming down substantially. And if he's lucky and the recent inflation surge doesn't spread into the rest of the inflation numbers, then he may very well just kind of sit back and let that all happen. And then he'll say, well, look, things are going in the right direction. We don't have to do anything. And at the same time signal that down the road, maybe the productivity story will come back as a reason to lower rates. But right now, it may be a do-nothing Fed for a while.
What if we see a labor market that does weaken, though? What's his reactionary function going to be?
Well, he kind of locked himself in. I mean, he didn't say very much except on price stability. He said that over and over again. And I think that if you get a weaker labor market, he's going to be called on if he suddenly becomes very liberal, in the mandate and says, well, people are getting hurt. We've got to focus on the unemployment rate. He basically said that in order to have a healthy economy, in order to have a healthy labor market, you have to have a price stability, which, by the way, is deja vu all over again, because that's what Powell had been saying for quite some time.
Do you think he was the one that threw out the proposal of discussing a rate cut at the meeting, just so he can, when he has breakfast with the Treasury Secretary, say, look, I threw it out there and I was pushed back?
We don't know. I mean, it's a good conspiracy theory.
Right, could work.
It makes sense. You could go back to the president and said, hey, I was the one who, but he said he didn't vote on the dot plot, so, I don't know where he is on all that.
So when you take a look at some of the projections coming out of a number of different Wall Street houses, some have been raising their expectations for a rate hike this year. You saw that with Deutsche Bank saying that with less communication, they could be more nimble and hike rates sooner. Even Citigroup, which has been on the more dovish side, pushing back the potential for a rate cut. If there are rate hikes, does that curtail the roaring 2020s and some of the enthusiasm that we're seeing in equities?
My story.
Your story. Yes. So does it affect it?
Last time I was here, I think John mentioned that we were 6 years into the roaring 2020s. If you just count it, we're actually 7 years into the roaring 2020s. And so if I get this year right, I only have 3 more to go. And every year there's, it's a roller coaster ride. You get all sorts of things to worry about. Maybe that's the next worry, is suddenly we're worrying that, if the Fed actually has to raise interest rates, then won't that spoil the roaring 2020s, the party we're in? And I don't think so. I think the economy has demonstrated its resilience. People have been kind of getting all bent out of shape about the bond yield being back up, but it's back to 4.5%. That's kind of normal. I think the bond yield is normalized. I think Fed policy is normalized. I mean, I think Warsh can just kind of leave things alone here for a while because the economy is performing just fine.
Those are two different things, though. Leaving it alone versus hiking rates, two different things.
Yeah.
And understandably, people are watching what he does, not what he actually says. At the same time, if you do think about hiking 2 times this year, which even Bob Michael of J.P. Morgan was talking about yesterday, how much does that infect potentially some of what we're seeing?
Look, when the payroll numbers came out real strong, we kind of reiterated our position that there was not going to be any rate cuts this year, and that the Fed would probably switch to a tightening bias at this meeting, which is exactly what happened. They didn't go from an easing bias in April to a neutral bias. They went right to a tightening bias, and so we got that right. But the thing that really surprised me is how hawkish that Warsh came across. If the Fed were in a position where they had to raise rates, it'd be a quarter, 50 basis points. It wouldn't be a big deal, in my humble opinion. And the bond market might actually rally on that. Back in 2024, when the Fed lowered the Fed funds rate by 100 basis points, I said, you know, I think you're making a mistake here because the economy is resilient and you haven't gotten down to 2%. And the bond market agreed with me, my bond vigilante friends. The bond yield went up 100 basis points. And even last year, they cut 75 basis points on the Fed funds rate, and the bond yield, where is it today? 4.5%. So they haven't accomplished anything. So lowering rates hasn't helped, but they may conclude. Look, the thing that really came across to me is that, and he said it, Warsh said, look, we haven't gotten down to our 2% inflation target in over 5 years. And he said he committed the committee to get down to, get inflation down to 2%. So, you know, how are you going to do that without raising interest rates? So I think the market's got it right now when we thought that there would be a tightening bias, and there could be an increase. If the Fed really wants to get it down to 2%, that may be necessary.
But Ed, what about the Fed policy on the housing market? Because he said that's one area where he does think it's restrictive.
Well, at the same time, he's talking about reducing the balance sheet and particularly focusing on, you know, the Fed's been talking for a while about reducing the mortgage-backed securities down to zero. That's not going to help the housing market. I don't think they've got an answer for that. You know, I mean, it's a shotgun. It's not a rifle. There's only so much the Fed can do. I'm a believer that, you know, if the Fed is not in our face as much as it was when Powell was around, I mean, I really don't mind less communication. I fondly had been calling them the Federal Open Mouth Committee.
Well,
you know.
Are you on the task force? Any
No,
of the
I'm
task
not
force?
on the task force.
This is my first question to everyone. Are you on a task force?
Yeah.
Which one?
Yeah.
Ed Yardeni, thank you so much for being with us. Wonderful to have you on the show. Ed Yardeni of Yardeni Research. As we analyze this new Federal Reserve under Kevin Warsh. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Isabel Lee. Isabel.
Hi, Lisa. The U.S. and Iran signing an interim deal, opening the door for 60 days of negotiations. The deal prompted criticism from some of Trump's allies, who say it amounts to a victory for Tehran and that the U.S. is conceding too much. Talks on nuclear issues and potential further financial gains for Iran are to follow. And the Fed holding rates steady at the first meeting of Chair Kevin Warsh. President Trump reacting to the news.
It's all right. Whatever.
And it looks like they might even raise them later this year. It's not clear. Do you have any
comment? It could happen. I mean, it's hard to believe. It just keeps a country down, you know, so it's so unusual. But we have a very good guy over there now, so I'm guided by what he wants.
Warsh said the central bank won't tolerate high inflation. And SpaceX shares falling for the first time since its record IPO, sliding 5% at the end of a volatile session. Still, shares remaining more than 42% above the IPO price, the low float amplifying the impact of retail buying. That's your Bloomberg Brief. Lisa?
Thank you so much, Isabel. Up next, a tenuous deal.
My whole life is all about deals. That's all I ever did is make deals. If they don't honor the agreement, we'll probably go back to bombing them.
Roule of CSIS joins next to parse through the details of this deal. This is Bloomberg Surveillance. Good morning. It is a tug of war, and right now oil prices winning out. We can see enthusiasm building under the hood despite a more hawkish Federal Reserve under Fed Chair Kevin Warsh. Right now, we're seeing that more pronouncedly in the tech sphere, in the more high beta areas of the market, up 1.6%. On the NASDAQ. You saw that also in the Kospi. It's around the world. Meanwhile, you could take a look at what's bleeding some enthusiasm into the Russell 2000, up about 1.2% ahead of the open, and that comes from the bond space. Today, this morning, we're taking a little bit away from what we saw yesterday after the statement by the Federal Reserve. Yesterday, 2-year Treasury yields shot up 13 basis points. That was the biggest jump since April of 2025, but that matched the largest increase on a Fed meeting day since 2008. Today, we continue to build on some of that increase, 4.19% on the 2-year yield with a full rate hike baked in by October. The yield curve flattening really notable. 30-year yields sharply lower than where they were yesterday, 4.88%, continuing down another 5 basis points today. To Ed Yardeni's point, and this I think is really important, if this Fed were to hike rates, that could potentially be good for the bond market and cause a rally. That is the point that maybe people are taking home when it comes to duration. But the oil story really front and center here. Oil prices back down to where they were just at the start of Operation Epic Fury. As people take a look at this deal, and Annmarie seem to think that, yes, there is some teeth behind it.
Well, you need to see what actually is happening in the Strait of Hormuz. And as we mentioned earlier, we are already seeing an uptick of vessels that are going through the Strait of Hormuz. Already we have Saudi Arabia being able to get their state tanker giant, being able to get some vessels through. So this is a good sign, a very good sign for the oil market. When it comes to this deal, though, Lisa, it didn't address the president's red line. And at the same time this was happening, signing a deal that a lot of critics were talking about didn't really address his red lines. His Fed chair that he thought was going to be dovish came out swinging as a hawk.
Yeah, well, let's get to that deal. Under surveillance this morning, the tenuous agreement.
My whole life is all about deals. That's all I ever did is make deals. If they don't honor the agreement, we'll probably go back to bombing them.
Here's the latest. President Donald Trump signing an interim peace deal with Iran last night. Bloomberg's Laura Davison joins us now for more. Laura, what do we know about the details of the deal and what went up to the actual signing of it?
Yeah, so the deal includes 14 points, but it really reduces the U.S. or brings the U.S. back to where it was pre-war. It's the end of a fighting, and it allows for ships to continue passing through the Strait of Hormuz as they were before the war began. But in there for Iran, to get them to agree to this deal, there's a lot of financial incentives. There's an easing of sanctions on selling their oil, as well as this $300 billion economic development fund funded by Gulf states. That it was sort of the carrots to get Iran to sign on to it. Important to note that this is also really just sort of the start line for negotiations. It basically starts a 60-day clock to come up with some details around some of the more thorny issues here. But this was really, a month or more in the making as you had Gulf allies really quietly shuttling behind the scenes between Tehran, Washington, and other Gulf states. Qatar playing a key role here of trying to figure out exactly how to get this deal agreed to. But this has been, a long time in the making. There's been some criticism from the U.S. side, including from Republicans. Folks like Bill Cassidy and Mike Pence have said that this is quite a bad deal. But we're already starting to see at least some Republicans breathe a sigh of relief as they head into the midterms and as gasoline prices cross for the first time since March below $4 a gallon.
Laura Davison of Bloomberg, thank you so much for that. Norman Roule of CSIS writing, the reported U.S.-Iran deal is best understood as a high-value pause in the current military phase of the conflict, not a durable strategic settlement. The deal buys time. It does not buy trust. Norman joins us now for more. Norman, wonderful to get your perspective. Can you just elaborate on that? Why do you think that this 14-point deal is simply a placeholder and not necessarily a roadmap for what's to come?
Good morning. The deal certainly has drawn a fair amount of criticism from both opponents and supporters of the administration for its language, but it provides a mechanism for the administration to transfer the process from a military conflict, which had no longer provided options for a low-cost way to restore access to the Strait and to achieve its previous goals, into a diplomatic process. Now, the diplomatic process may not offer any optimism for its success, but the diplomatic process immediately relieves pressure on the world energy markets and the world economies and sort of reshuffles the deck of options for the administration. Now, in terms of what the Iranians will get out of this, absolutely, they will get some financial relief. But in fairness, the $300 billion fund is described as a plan. There's absolutely no reason to believe that anyone in their right mind will donate money to this, given the fact that money will be hostage to Iran's policy, future sanctions, and that Gulf states have been victims of Iranian attacks and are devoting most of their investments to their own economies. And my last point that I would make on this is that this process itself is tenuous, and the president and the administration will need to prove early on that this process is narrow, it is reversible, and it is achieving something besides giving the Iranians additional liquidity.
Norman, given the fact that it is narrow, what happened to the president's own red lines that he's spoken about for years?
Well, his red lines that he mentioned again in the press conference yesterday remain threefold. First, Iran cannot have a pathway to a nuclear weapon. That remains part of this process. And indeed, that's the primary effort of upcoming talks. Now, he's talked about missiles, and his statement yesterday is that Iran can have a normal complement of missiles that any country in the world might have. Now, that's not an ICBM. That's not an intermediate range ballistic missiles, but that would be a defensive complement that any country would have. And that's got to be worked out with its neighbors. And last, Iran's got to do something about its militias, that it can't have a process. The sense is that there's conversations that are going on the side of this deal that will work that out, but that's a complicated regional diplomatic issue that they don't want to put in the same basket as their initial discussions with the already very hard nuclear issues.
The vice president, when he was making the rounds, doing some interviews with reporters, said that Iran's regime is, quote, a much different group of people for whom, quote, something has fundamentally transformed. Norm, do you see any evidence that this is really a new regime?
Well, they're a new generation. They were raised in a different world, a post-2003 worldview. So certainly they have a different perspective, but there's no evidence whatsoever that they believe that Iran should not be a regional hegemon, that they don't believe that they have a right to and a reason to run militias such as Hezbollah and the Houthis, and that they won't remain a threat to their neighbors in the near term. But clearly there are conversations going on between the administration and some elements in the Iranian government that have given the administration reason to believe this may be the case. The trick is the administration needs to demonstrate somewhat early on in the process that this process is proving that possibility may be realized.
Norm, do you think that this realigns the U.S. in the region? It seems like the Gulf nations are happy that the kinetic conflict will at least cease for now. At the same time, Israel is pretty upset because some of their goals have not been reached. Do you think this aligns the U.S. more closely with Gulf nations and further away from Israel?
Well, let's look at Israel's goals. Iran's nuclear program has been devastated. Iran's missile program has been severely damaged. Now, at the same time, the regime remains in place. The militias are no more active than they were prior to this. The question, I think, for Israel is how long would that conflict continue? And there are people in Israel and the United States who would like this conflict to continue, and that's an ideological position. Now, within the Gulf, they're paying the price for that conflict with the missiles striking their population. There's no evidence the Gulf states as a group oppose the deal the president has put forward. And the United States is seen as the indispensable security partner of the GCC. It may not be sufficient to be the only partner, but it is the indispensable partner. And it leaves this conflict much closer to all of these of the GCC states.
Do you think that buying time means 60 days, or do you think that buying time means till the end of the year?
Yes. I think the answer is it could be either, but it's going to depend upon events. And that's important because all it takes would be some sort of high casualty event that might take place, God forbid, in Lebanon, which remains a separate arena from this. Neither Israel nor the Lebanese Hezbollah were parties to this agreement, although Lebanon is mentioned in the agreement. And some sort of event could take place during this, the discussions, which could take these conversations out of joint and move this into a different sort of dynamic. But the administration is going to look for some way to show that the Iranians are moving in the right direction, and that will take time. Remember, nothing moves fast in talks with Iran, no matter which administration is dealing with them. And these issues are issues that every administration has spent years struggling to work with Iran. So no, it would be unfair to expect that the Trump administration could achieve any of this quickly.
Norman Roule of CSIS, thank you so much. It does seem like buying time is the takeaway at a time when the market is looking on this very favorably.
And buying time at a time when you have a midterm election, it's peak driving season, and you cannot afford $5 a gallon gasoline.
And now it is below $4 for the first time since March. Coming up, Jennifer Huddleston of the Cato Institute as AI leaders make their case at G7. That's coming up next. This is Bloomberg. this is one of the most interesting Thursdays I could imagine in terms of price action. You have a risk-on move, particularly led by the tech stocks, but not because of what you might think. We did have a Fed meeting yesterday. You might infer, oh, wait a second, this is because the Fed was dovish. Not in the slightest. This is because oil prices are falling. NASDAQ futures up 1.6%. You could also see the Russell 2000 up 1.2%. Again, you would think, oh, this comes from a Fed that is easing off some of the rate hiking expectations that have been baked into the market. Right now, if you expected that, you would be completely wrong. If you take a look at 2s, 10s, and 30s, you can see that two-year yield continuing to just grind a little bit higher after yesterday seeing the biggest one-day move in that 2-year for a Fed day going back to 2008. Almost back at that 4.2 level on that 2-year with a rate hike baked in. You could see a rally into the long end of the curve. This is the yield curve flattening that we have seen in a pretty violent fashion over the past couple of hours. 30-year yields now 4.88%. But a lot of this is overlaid with oil prices. And if you take a look at oil prices at the lowest since the beginning of March, you can understand, AMH, how this really is the driving story right now. A deal in Iran is enough to give this market more ammunition to go up that much further.
And it's not just the fact that the president signed the deal last night. The negotiations are going to continue to work out some of the more difficult issues, especially when it comes to nuclear with the regime. It's the fact that we are actually starting to see an uptick of oil through the Strait of Hormuz. And as you noted, we're seeing tankers that have their transponders on. They aren't trying to do this, in the middle of the night with their transponders off to sneak by. The Strait of Hormuz is slowly starting to open. Now, is it going to take a lot of time to get those 600 vessels that have been trapped out? Yes. But this is moving in the right direction. The market sees more barrels are coming on.
And they see this as being a long-term phenomenon. If you take a look at the December contracts of both WTI and Brent, WTI, it's less than $72, down from a high of about $85 last month. When you take a look at the Brent December contract, $76. That is down from a high of $93. I mean, AMH, this is a huge shift in expectations.
Well, this is why the IEA the other day came out and said we will see demand destruction 2026. We're seeing that now, especially in parts of Asia. We have seen some of that. But what they're seeing for next year is a supply glut.
Right now, 3 hours away from the cash open, some really interesting stories under the hood as well. Here are your morning movers with Vonnie Quinn. Vonnie.
Yeah, Lisa, beyond the fact that we have a general market enthusiasm showing up in equity index futures today, you have Intel up 9%. This after the president truthed out that Apple is going to work with Intel on U.S. domestic chip production. Now, this is a huge boon for Apple, which has been trying to find external customers, right, to build domestically. Apple has already had discussions with Intel, and of course, the president citing the example of NVIDIA and Elon Musk's Terafab project. Bear in mind, Apple has surged fourfold since the U.S. invested in it last August. We're also seeing an Apple impact on memory chip makers today, right? Apple's CEO, Tim Cook, gave an interview to the Wall Street Journal in which he said they were finally going to have to up prices because it was just becoming unsustainable, the memory chip price increase. That, of course, might mean good things for memory chip makers and their margins. And you can see Western Digital, SanDisk, and Micron all up to the tune of 4% plus today. And then we're also keeping an eye on SpaceX, of course, as well. Very volatile day. It was up 4% and down 7% at various points in the market session. However, with yesterday's move, it just gave up the previous day's gains, right? Yesterday was down 5%, looking to a small decline right now again. But we're still at 190, more than 40% above that IPO price.
Thank you so much, Bonnie. I don't think anyone's crying about that, at least not if they're holding the shares. On our radar this morning, the U.S. and Iran signing an interim deal to end the war and reopen the Strait of Hormuz. President Trump defending the deal, with some Republicans saying it amounts to a victory for Tehran. The agreement will go into immediate effect. Fed Chair Kevin Warsh ushering in a wave of change at the central bank.
I'm appointing a task force in each of 5 areas. You'll hear quite a bit more about these task forces. That'll be taken up by the task force. We've got a task force for that. The good news for you is we have a task force for that. We have a task force on that too. I've been on a task force or two in my life. It's one of the things we have a task force to do.
So there's going to be a task force for that. Warsh saying 5 task forces will consist of internal and outside experts to advise the Fed on core objectives. And Microsoft growing its footprint in China despite the heated AI arms race with the U.S., selling models from OpenAI and its Azure cloud services to top Chinese firms, including over $1 billion in orders from ByteDance. A really interesting moment right now, given some of the pushback in the U.S., given the U.S. tech firms and certain bans over in China. They say it's an independent operation, but at a certain point, You start wondering if the lines are getting blurred.
Do you know who's going to be interested in this? There's a congressional task force when it comes to China, the China Select Committee. And this is something that I imagine is going to irk them. Microsoft thinks this is useful to have this presence in China. And the President, Brad Smith, actually said recently during congressional testimony, it's relatively small amount of money they're making there, 1.5% of overall revenue. That's not the issue. Fact of the matter is this administration has serious export controls on Anthropic right now, and their two models that they don't want in the hands of adversaries. Are they going to start to do that and follow through and tell other firms like Microsoft, we want you to dial back the work you're doing in Beijing?
It's not just congressional task force. It's also OpenAI. OpenAI is not pleased either because they're worried about China distilling some of their models and then replicating them in the region. The bigger question here is what kind of firewalls are there? The reason why one company gets an advantage in being in many different places, particularly the U.S. and China, is you get exposure to both areas and you can share information in a way that can add to the development of new things. How much can they do that if there truly is a firewall? At what point are they benefiting? They might say this is a very small part of sales, but it's rapidly growing and they are very proud of it in internal calls.
Exactly. And also this comes from a place where we know have had issues with intellectual property theft, have had issues with harmful uses. The technology is potentially moving faster than the regulation can and catch up. But I think the direction of travel is more towards the Anthropic route of the world, not what Microsoft is doing.
Let's stick with tech. AI executives pitching their case at the G7 summit. Anthropic boss Dario Amodei arguing world leaders to, quote, resist the temptation to splinter over the rollout of advanced AI models. Jennifer Huddleston of the Cato Institute writing, there is a conversation about the role voluntary international standards could play in AI. Industry agreements and norms could be an alternative to more heavy-handed regulation. Jennifer joins us now for more. Jennifer, there are two issues here. On one hand, there's an issue of national supremacy when it comes to AI dominance. On the other, it's actual security as some of these models get ahead of what a lot of people are prepared for. Which do you think is the more pressing concern for national leaders?
You know, we've certainly seen a debate recently about what is the best way to have a conversation around AI and around some of these serious cybersecurity risks. We saw this weekend export controls imposed and kind of an attempt to limit any foreign nationals, including allies, from accessing Anthropic's most advanced model, Fable. So as we're starting to see these conversations at the G7, I think there is a kind of question of what can be done, particularly given American leadership in AI, to ensure that there is a serious discussion around cybersecurity, but not one that could harm the industry long term or create these kind of scenarios in the future.
Do you see any pathway, Jennifer, to getting industry norms that would be accepted by competitors that could set them back versus, say, pedal to the metal, go forward and try to develop as advanced technology and systems as you can?
You know, we have seen that these companies are thinking a lot about safety in their own sense. We saw this when Mythos first launched, that there was an attempt to keep it very small, to make sure that they were testing the product before they launched it more widely. So if there were potential vulnerabilities that they could self-address. There also can be opportunities to voluntarily provide this information in certain cases. Again, something that allows that kind of innovation and the changes in models in what is a very dynamic industry versus a having to prove that there's no risk at all type of scenario that we could see with more heavy-handed regulation.
These AI leaders met amongst the president with other leaders, notably European leaders. How big is the gap right now to where the Europeans want to regulate AI and where the United States does?
As we've seen with other technologies in the past, there's a pretty significant gap. The EU has its AI Act that is a much more regulatory approach when it comes to AI. Additionally, we've also seen other laws like the Digital Markets Act come into play with some of the companies not being able to launch their most advanced products. For example, the latest AI-enabled iPhone isn't going to immediately be available with that feature when it launches in Europe. We are seeing that the U.S. continues to try and take this light touch approach. And while there's discussion of a congressional framework or further actions around issues like cybersecurity that may need to be more specifically addressed or have norms established, there does seem to be a continuation of this trend where Europe seeks to regulate tech companies while American companies are the leaders in innovation.
Jennifer, in some aspects, they're taking a light-handed approach, but not when it comes to Anthropic. These are serious export controls, and it's very heavy-handed. So do you see the administration potentially rolling back those export controls? What kind of deal do you see them getting done with Anthropic?
You're right to point out the distinction here. We've seen several actions recently, whether it was calls to invest in American AI companies, whether it was something like the export controls on Anthropic that we recently saw, that seemed to be a deviation from this more approach that has focused on regulation that could really allow innovation to take off, and that very light hand approach. So we are continuing to see that this administration isn't just looking in terms of how do we build that framework. There are serious concerns that have been raised around how this could be picking winners and losers in this very dynamic space, as well as concerns about how this could impact speech or privacy rights of Americans and of American innovators.
Jennifer, when this first came out in terms of Mythos and the potential threat that we were hearing from Anthropic, there was some speculation that it was overdone, a way of trying to make them feel like their models were essential, important, and must-have for different companies, regardless of how expensive. But as we've talked to an increasing number of executives, there is real worry there about what some of these models can do. And Christine Lagarde raised the specter of a possible financial crisis as this gets rolled out. From your perspective, can you just put into some sort of light how serious the risk is and how seriously different executives are taking this?
With any model, with any technology, there's going to be a risk of harm as well as a risk of benefits. And one of the things that I think we're seeing is that executives, companies are realizing they have to prepare both for the benefits of AI and also making sure things like their cybersecurity are up to date. In addition to the cybersecurity risk, we've also seen how models like this can improve cybersecurity, how they can identify potential vulnerabilities and identify potential attacks that can actually allow companies to respond to those quickly rather than having those vulnerabilities exploited.
Jennifer Huddleston of the Cato Institute, thank you for being with us. And I will just say, on having some of these AI leaders in the world stage really highlights how much they have become the heads of state of their own. Essentially, their size of a state and the influence of a state as well.
Well, if you truly believe their technology is a new industrial revolution, it's going to impact every single economy. And if you're concerned that it's going to get in the hands of adversaries, then this has to be a work in progress with your allies, which is why it was pretty incredible to see all of these leaders there at the G7. At the same time, there are discussions underway of how this administration might take an equity stake in some of those companies.
Yeah, and we'll talk more about that coming up. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Isabel Lee. Isabel.
Hi, Lisa. President Trump signing an interim deal to end the war with Iran and reopen the Strait of Hormuz. The president insisting Iran will never obtain a nuclear weapon, but has the right to enrich uranium for electricity, access frozen funds, and develop ballistic missiles. And gas prices dipping below $4 a gallon for the first time since March. According to AAA, the national average for regular unleaded is now $3.99. Prices are still well above where they were before the war and aren't expected to return to those levels until next year. And this is for Annmarie, a historic day in New York, the Knicks getting their first ever ticker tape parade. The parade through the Canyons of Heroes kicking off at 10 a.m. Eastern and is expected to draw millions of fans. Some fans are paying as much as $950 for professional line sitters to secure a front row view. So that's a lot. That's your Bloomberg Brief. Lisa?
Thank you so much, Isabel. I just want to note that Annmarie is getting the mug ready. She's putting her hair together. She's getting her orange and blue outfit prepared. This is your last day.
But I'm not going to the parade. It's too intense. Also, you have to line up. You would have had to line up 45 minutes ago.
Well,
my phone is blowing up with people saying the subways are packed with Knicks fans. It's going to be crazy. Get there very early. You can't bring a bag. So it seems like by the time we get off this show, it's work. Work got in the way.
Oh, clearly. That's what we're going to say. That's why she didn't pay $950 to have a line sitter get in for her. At this point, though, we can expect that maybe her blue and orange outfit has been fully exhausted.
Because we don't want anyone to think it's for the Mets after the Knicks pandemonium is over.
Up next, we can have a little bit of love for the Mets and the Yankees. Go New York. Up next, the Hawkish chart.
We have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do. The commitment to deliver is strong, unanimous, and unambiguous.
Kai Hay of Goldman Sachs joins next. This is Bloomberg Surveillance. Good morning. Here's Soap. The enthusiasm in markets continues despite some sell-off in the bond market. Let's take a look at what's going on. You can see equities bleeding higher, grinding upward. 0.8% gain on S&P futures. You're seeing a bigger outperformance from the tech sector. You are seeing dollar strength. Watch the Japanese yen that yesterday was flirting with some of the highest level, or the lowest levels, I should say, versus the dollar, the weakest levels going back to 2024. This morning, you're seeing it across all of the G10 currencies. Euro 114.64, and 10-year yields going lower. This is interesting. The yield curve flattening that has come back into the market with the expectations of rate hikes with crude now lower by 1.7%, $75.49. The story really yesterday into the afternoon after the Fed meeting was that 2-year yield that jumped 13 basis points on the day, the biggest one-day increase going back for a Fed meeting to 2008. And we're looking right now at the 2-year yield continuing to grind higher, getting close to the levels where it was on February of 2025. Under surveillance this morning, the hawkish turn.
We have the capability and commitment to deliver on our price stability objective of 2%. That's exactly what we're going to do. In the Fed's review of its strategy, the Fed statement says that inflation is primarily determined by monetary policy. You bet it is. The commitment to deliver is strong, unanimous, and unambiguous.
Here's the latest. Fed Chair Kevin Warsh vowing to get inflation under control at his first policy meeting, with nearly half of the committee forecasting higher rates by the end of this year. Kai Hay of Goldman Sachs writing, our base case remains that the Fed can just about avoid hikes, but the path is narrow and there will be a high premium on the incoming inflation data. Kai joins us now for more. Kai, thank you so much for being with us. Let's just start there in terms of your reaction and whether you changed anything in your rate hiking expectations as a result.
Oh, good morning. Look, clearly the meeting was unambiguously hawkish, but there was a lot more actually that we would like to focus on. I think that the communication was extremely clear, prioritizing inflation in the short term and making it very data dependent as to how the Fed is going to react at the next meeting. So what does that mean for our expectations? Look, it means two things, really. The first one is we will also look and track the data very, very closely, particularly inflation data, particularly to understand how sticky inflation will be and continues to be. But then there's a second factor, and looking at the 2-year yield chart, I think we will see much more volatility in the 2-year sector going forward. And that's a combination of, firstly, focusing on inflation, calming down the longer end of the curve and seeing that flattening action. And then a lot of commentary around kind of forward guidance indicating that there will be less of it, that the Fed will be more data dependent, and a lot of that will translate into 2-year volatility. So we will see much more of the type of price action that we saw last night.
The irony, Kai, is that we could see less volatility at the long end, right? I mean, how much does this actually increase your expectations of stability at the long end of the yield curve and endorse some people who have been going into duration as a result of this promise to get to price stability?
Yeah, great question. Look, it's early days, but I think the chairman started off very, very well in terms of reducing volatility at the long end. And we spoke about, the impact communication will have and the clear focus on inflation. There are also these task forces that he alluded to yesterday, and they were very clearly designed to kind of re-examine the kind of operating model of the Fed. And we're very curious as to how that develops. If there are other sources of data, different inflation framework, communication, and all of those things, we need to see how that pans out. But that could very well translate into less volatility at the long end, which in our view would make it much more attractive for investors.
Right. Basically, what Kevin Warsh said and announcing all these task forces, are you actually more interested in buying treasuries now?
The task forces themselves, we don't think right now are going to drive kind of allocation into duration. But I very much the kind of focus on inflation and, keeping the longer end under control, the Fed doing its job in getting inflation closer to the target. all of that is very supportive for treasuries. So yes, at the margin, that's a positive.
We've seen individuals on the Fed get concerned with higher oil prices. Obviously, this is all coinciding with the fact that we have this deal the president signed. We're actually seeing more ships move through the Strait of Hormuz. Did you get a sense that Kevin Warsh is concerned about other parts of inflation as well? And where are those other parts?
Look, I think he said very clearly yesterday that second, third order effects are important, right? So, we've got to now track a little bit the kind of reduction in the oil price and how far it will drop, because of course, there's every indication that countries are going to replenish their reserves, and that's going to put some upward pressure on oil. So we've got to see where the equilibrium gets to. But then the second and third order effects are very, very important, right? He talked a little bit about the housing market. He talked a little bit about the financial markets, financial conditions. We're going to continue to focus on the labor market and see how that develops. So I think you're right. It is not just the price of oil, but how that propagates throughout the economy. That will be very important.
Kai, this is my stock question to everyone in fixed income who comes on this morning. Are you on any task forces?
No.
Okay. Well, this is to me going to be a key question. Not yet, but the door is open. A key question for a lot of people is going to be exactly who are shaping some of these expectations. There were 5 different task forces. They are a range of different issues, from communications, balance sheet, data sources, productivity and employment in an era of AI, and sources of inflation. Kai, how concerned are you about the balance sheet? We've heard about that as one of his goals, and that directly feeds into liquidity, given some of the tweaks that the Fed has made around the edges that have really fueled a wave of liquidity, at least earlier this year.
Well, let's see what comes out of that debate. Actually, the positive is that there will be a debate, there will be a task force, and people will look at that. It is not just the size of the balance sheet, but the speed of reduction. It is not just only the speed of reduction. It's then also what will be the kind of duration of the issuance that the Treasury will bring to the market. So there's a lot of variables that are important. In principle, the idea of reducing the balance sheet in a kind of controlled environment is not necessarily a bad one. Let's see how that evolves. But I wouldn't call it a concern at this point.
Kai, when you do get called for the task force, please let us know. We'll have you on to talk about what some of the details are. Kai Hay of Goldman Sachs, really appreciate your insights as we analyze what we heard yesterday, really putting his stamp yesterday on the Federal Reserve.
Oh, yeah. Kevin Warsh came out swinging. Everything we were speculating potentially he could do, he delivered on. There was no dot. He talked about price stability. The statement was much shorter, less word count, and this is what we expect going forward. Also, shorter answers. There is going to be less communication and less forward guidance, or no forward guidance, from this Federal Reserve chair.
We've also talked about how the ECB is a single mandate central bank. We've talked about other central banks and how that's been a bug, not a feature. He seemed to indicate maybe it was the other way around, talking much more about inflation, not necessarily employment, and said one line: inflation has been running well ahead of the Fed's long-stated inflation goal of 2%. That's been going on for more than 5 years, and in his words, that's got to end now.
When Neil Dutta heard what all of this was about, he put out a note and said, he concluded noting that the FOMC would deliver price stability reminds me of the single mandate stuff from Paul Ryan. And actually, some individuals that we've seen hired by Kevin Warsh, some of them have been proponents of just looking at price stability and inflation.
So it's not just the Fed. Other central banks also on deck. Coming up next, Pooja Krumra of TD Securities as we get a Bank of England decision. Colonel Wayne Sanders of Bloomberg Intelligence, Anastasia Amoroso of Partners Group, and former Kansas City Fed President Esther George. Maybe she's on a task force. This is Bloomberg Surveillance.
Appointing a task force in each of 5 areas that are central to the broad conduct of monetary policy.
This is a welcome thing. The Fed needed to change. Maybe it is time that they try a different approach.
He seems to be very smart about getting everybody on his side and getting the consensus.
You have Warsh basically telling you we're going to get rid of the dot plot. The task force has its job ahead of it.
There was actually kind of a positive tone about both the economy and the functioning of the institution.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance. Stocks rising on the heels of a deal between the U.S. and Iran. Oil prices plunging. Equity traders shrugging off a hawkish turn by the U.S. central bank yesterday. Bond markets digesting a hawkish turn more broadly around the world. The Bank of England just dropping their decision. No change necessarily, keeping their guidance that they stand by to act on inflation. And Andrew Bailey, the governor of the Bank of England, saying that the pressures from the Iran war are still in the pipeline despite the truce, highlighting the concern here that even though there is a deal with respect to the U.S. and Iran, that doesn't end all of the concerns.
But how quickly do those pressures start to ease? Because at the same time that we just got this BOE decision and they are concerned about where they're seeing the elevation of energy costs, Iran is releasing the text of the MOU and says that Iran will arrange Hormuz ship passage with no charge for 60 days. So I think Norm Roule put this really well earlier in the program, talking about the fact that this is really an end of military hostilities. It's a high-value pause in the current fighting and current scenario. And 60 days, we are going to see a large number of vessels be able to safely get out of the Strait of Hormuz.
Just to note that this was a 7-2 decision in terms of 7 people voting to keep rates at 3.75%. 2 members voting to increase the bank rate by 0.25 percentage points. So on the margins, a bit of a hawkish tilt. Lizzie Burden has more. Let's head over to Lizzie for the details. Lizzie.
Lisa, this is exactly as expected. The Bank of England doing absolutely nothing, keeping rates at 3.75%. It's hard to seem as hawkish as the European Central Bank, which, of course, hiked rates last week, or to match the hawkish message from the Fed last night, our time. Plus, there's good reason not to be as hawkish in the UK. We had inflation yesterday coming in softer than expected. Oil prices, of course, dropping on this US-Iran memorandum of understanding. At the last BOE meeting, we were above $100 a barrel on Brent, and now we're sub 80. But, of course, the Bank of England wants to wait and see what happens geopolitically and how it feeds into the domestic economy as well. So, as you say, Andrew Bailey here saying that pressures from the Iran war are still in the pipeline despite the truce. They want to see what happens over the next 60 days and beyond. Now, the vote split, as you say, 7-2 as expected. In terms of the guidance, no change. They stand ready to act on inflation, they say. And so looking ahead, traders have been pricing in one more Bank of England rate hike for this year. Economists saying maybe they'll just be on hold for the rest of the year and the next move could be a cut. And if you look at the market reaction here, the pound pretty much where it was before this decision, down 0.5% at $1.32. Gilt yields on the 2-year up 6 basis points at 4.20. So again, pretty much where we were before all of this, because you've got to take into account the Fed, take into account the war and the politics that's going on in the UK today, a special election which could be having its own impact on UK markets.
Lizzie Burden, thank you so much, as always, for breaking that down. Right now, also, you're looking at the pound versus the dollar, losing clout pretty significantly, down about 0.5%, as you see it fall to 132.19 versus the dollar. Again, this sort of points to the question of how high the bar has gotten for other countries and other central banks as a result of the Fed's hawkish turn. They've been making it easier by being somewhat dovish relative to the others.
Absolutely. For the rest of the world, Kevin Warsh coming out as his old Kevin Warsh, a hawk, plus, on top of that, the MOU coming out from the President of the United States and potentially could be easing some pressure on energy prices. That's going to help the rest of the central banks.
So bond markets are reeling in all of this information. Here's the view from Wall Street. Pooja Krumra of TD Securities writing, upside risks remain. We postpone our call for a last Bank of England rate cut from the November meeting to April of 2027. Pooja joins us now for more. Pooja, thanks for being here. Can the Bank of England wait so long, given some of the pressure now coming from the U.S. Central Bank?
Totally with you. But when it comes to BOE, they do have a trade-off between higher inflation as well as weak output. I think at this stage, even by staying on hold, they are being restrictive. But again, this is something that we are dealing with on a rolling basis. And as like all central banks, BOE has been pretty much blatant that they are ready to act if required. I think price action-wise, we are reacting much more than what we got from the statement. I think primarily because it's the Fed effect that we are seeing in markets today.
Right now, I'm wondering how much, Pooja, you think that inflation will ultimately be proven to be an overstated story as a result of the MOU with Iran, of this idea that potentially ships are already starting to go through the Strait of Hormuz.
So, I don't think central banks want to be actually complacent right now, because I think the key thing, right, is not just the spot prices of oil, it's how you look at the forward futures when it comes to oil. And that's not coming back that quickly to the 60 level, which means that most of the central banks have to deal with elevated inflation pressures. I think for BOE, the only different thing is that our starting ground when it comes to economy has been weaker. And that is something why we feel that even if they act, they are going to be the last of all the central banks here.
When it comes to the ECB, given what we're seeing with the BOE standing on a hold, do you think the ECB acted too soon?
I don't think so. In terms of, first of all, they did not, as Lagarde has been pointing out, that wasn't an insurance hike. I think they were pretty much clear that the inflation pressures were going everywhere. Whatever data, whatever the model that they were following when it comes to inflation expectations from consumer households, as well as the PMI, that suggested that some form of restriction was needed. I think what is the difference between ECB and BOE is ECB was at neutral and BOE is at restrictive policy. So, ECB had to make the first move to come a bit more restrictive.
Given the fact that we are seeing oil prices lower, Lisa talked about what's going on with the MOU. The Iranians have released the text. Ships are actually moving through. Do you think the ECB is just one and done now?
In all the scenarios, it was never one and done. They need at least one or two. The minimum they talked about was 2 hikes, right? I think the scenario with respect to the war definitely says that July possibly remains on hold. But September, if the situation still remains the same, i.e. of elevated oil prices, if the disruption is not yet done, ECB will be ready to act. And I think that is a clear message that we got from the meeting. And we also keep that option open. I think for BOE, it's a tricky one, whether they still want to hike when the signals are not that strong. Because if they hike here, it is hurting the economy. And especially, it's not just about monetary policy ever in UK. We have the fiscal policy as well as the political policy also coming in and hurting the markets.
Pooja Kumar of TD Securities, thank you so much for being with us as we get that Bank of England decision to hold rates at 3.75%. The tone was set yesterday with a very hawkish Federal Reserve, a new Federal Reserve, with Kevin Warsh taking the helm, the 5th central bank head going back 30 years. Michael McKee was there in the room. He joins us now. Mike, it seems like that was a press conference that may not become the status quo going forward. He might pick and choose when he has press conferences.
Yeah, that was one of the top questions, I think, not just because I asked it, but everybody wants to know what kind of communications are the Warsh Fed officials going to be making. And the press conference has become a major thing for the markets in terms of understanding what the Fed is doing. And so if they change that, it's going to take away a lot of information, especially if suddenly Kevin Warsh, the chair of the group, is not as accessible as he used to be. So we'll have to wait and see what they decide in their task force, but it is something that people might have to get used to.
Task force was definitely the key word in a drinking game, drinking water, of course, yesterday during the press conference. Mike, there was a sense, though, that 9 out of the 18 members did vote to, or did put in their dots, the idea of a rate hike this year. Was your sense that that was more verbiage, that it was a desire to take action?
No, I think it is a real desire to take action. There had been a growing sense among members of the Open Market Committee that they really needed to do something about inflation, because not only is it rising, but it has not gone in the direction of 2% for quite some time. And they haven't hit 2% in more than 5 years. So they really started to think that this could unsettle inflation expectations, and people could begin to think, especially with talk about changing monetary policy under Kevin Warsh, people could begin to think that inflation is going to be regularly higher, and they don't want that to happen. So the pressure has been building for some months. We saw it right after the first of the year, when we started to see people dissent or talk about the idea of the Fed on hold. Then it became more people thinking maybe we should change the guidance so that people know we could raise rates if we need to. And now you've got 9 people who think that they should raise rates.
Michael McKee, thank you so much, and great reporting yesterday. AMH, a lot of this has to do with oil prices. That was one of the real reasons why everybody got really concerned about inflation. The reacceleration, yes, coming from other places, but most notably within gasoline. I mean, really, this is the key question. How much does that pressure ease rapidly, as we're seeing in the oil futures market?
Well, right now, you have Brent and WTI both with $70 handles. You have gasoline under $4 a gallon. That's pretty extraordinary, given the fact that the Strait of Hormuz is just beginning to really open today with this MOU. We do have to remember, though, how difficult is this going to be? I'm looking through some of these headlines coming from the Iranian text that they just released. How the U.S. won't impose any new sanctions, how there's not going to be any tolls for 60 days. It all sounds great for 60 days. What happens after?
Yeah, Norm's saying that it could potentially be 60 days. It could be potentially
maybe it goes longer
for a bit longer. The idea, though, that the Bank of England highlighted that they are looking to understand how quickly these pressures abate, given that everybody needs to restock their inventories. In the U.S., the Cushing metric coming to its lowest level going back to 2004.
Everyone has used their inventories. We're living on those buffers right now. So not only do we need to replenish those buffers, but also get to places that have had demand destruction, to places like Asia. But looking out to next year, and you brought up what's going on in futures, we are seeing lower prices in December. You're seeing a $69 handle when it comes to this time next year. And the IEA is saying, well, guess what? We're going to have a supply glut.
All right, well, let's get to other stories that are happening this morning, and not just on the Long Island Expressway. Here is your Bloomberg Brief with Isabel Lee. Isabel.
Hi, Lisa. Iran's president publishing the text of the interim deal between Tehran and the U.S. on X. Some of the details include traffic of commercial vehicles through the Strait of Hormuz to start immediately with no charge for 60 days, as well as the U.S. will fully end its naval blockade in 30 days. And Intel shares surging in pre-market. President Donald Trump saying the chipmaker will work alongside Apple to design and produce semiconductors domestically. Trump posting on Truth Social, "I decided to help Intel because we need to design and build our chips right here in America." And in sports, England beating Croatia 4-2 at the World Cup. The British captain Harry Kane scoring 2 goals, bringing his career World Cup total to 10. Jude Bellingham and Marcus Rashford also scoring for the 3 Lions. That's your Bloomberg Brief. Lisa?
Thank you so much, Isabel. Up next, signing a deal with Iran.
My whole life is all about deals. That's all I ever did is make deals. If they don't honor the agreement, we'll probably go back to bombing them.
Colonel Wayne Sanders of Bloomberg Intelligence joining next. This is Bloomberg Surveillance. Good morning. Rally holding in U.S. equity markets despite the hawkish tilt across the world from central banks. Right now, you're seeing equities rallying up about 0.7% on the S&P. Futures higher, although pulling back just a touch from where they were earlier. Really the outperformance in big tech and, frankly, the Russell 2000 with yields lower on the long end right now. 10-year yields 4.46%. Watch for that yield curve flattening that has really reasserted itself in strong form. And crude prices driving a lot of the enthusiasm, down almost 2% on WTI to $75.38. Question how much this can hold given the restocking that's necessary, the deal that still is ongoing. I mean, there still is quite a bit of uncertainty.
Right, but we did get the MOU text. The Iranian president has released it on Twitter. Iran to arrange for ship passage through the Strait of Hormuz with no charge for 60 days. So obviously what happens after that? No Arab country is going to accept a fee of an international waterway, neither would the United States. So you do see potentially some issues that are going to brew, but they're being put down the road. The can is being kicked. And for right now, this is good news because it's not only what they're saying, it's what they're doing. And we are seeing some vessels be able to now traverse the strait.
Under surveillance this morning, signing a deal with Iran.
My whole life is all about deals. That's all I ever did is make deals. If they don't honor the agreement, we'll probably go back to bombing them.
Here's the latest. President Donald Trump signing an interim peace deal with Iran last night. Bloomberg's Laura Davison joins us now for more. Laura, we did get some confirmation, as AMH was talking about, from the Iranian side. What's the latest?
So the latest is that this 14-point plan has essentially been confirmed and by both sides, which is really a first for the past 4 months. We've had a lot of mixed messaging come from the Iranian side and the U.S. side. So that is a step forward. However, this deal, while it does, allow for the Strait of Hormuz to start opening up and at least toll free for 60 days, it also has some financial benefits in there for Iran, sort of as an incentive for moving forward with this, potentially a $300 billion economic development fund, the easing of some waivers, and also down the line some access to its frozen assets. It's being panned by several. Both the Israelis aren't very happy with this deal, as well as in the U.S. Even some from Trump's own party, some Iran hawks, have said that this deal gives too much away and that the U.S. really only gets a pledge in advance while Iran gets some tangible benefits. This really is just the starting line here. This really starts the talks for more thorny issues on what the future of Iran's nuclear program looks like and what a more lasting peace looks like in the region and what the future of the Strait of Hormuz looks like. But for right now, we're seeing positivity in the markets. We'll see where we are 60 days from now.
Laura, why was it brought forward? The initial expectation was for the MOU to be signed on Friday. It was brought forward to last night. Do we have a sense of what was behind that?
A couple different things. One, Trump happened to be at Versailles for a dinner, sort of the home, the birthplace of big global treaties. So there's a little bit of a photo op and sort of a symbolism there that the White House was looking to project. There was also some uncertainty about exactly what was signed on Sunday. They signed it again yesterday, and then potentially there is still talks about some sort of in-person signing in Switzerland. So this will be the deal that will be signed on multiple occasions.
Bloomberg's Laura Davison, thank you so much for being with us. Colonel Wayne Sanders of Bloomberg Intelligence joins us now. He was also at Versailles? Maybe not. I don't know. How many people can say, oh, I just happened to be at Versailles? Colonel, I'm just curious from your perspective, what you think has been accomplished with the signing of this deal?
Well, I think the biggest thing that I like about what's going on now is that it's given the 60 days right up front and saying this is where we're actually trying to go. The opening for Iran's side of the house, the fact that they actually have one singular voice right now that's saying that we're moving forward with this deal is a really good sign. Up until now, we've heard from President Trump say, hey, the things are moving forward, but then we would hear multiple different things from either an IRGC counterpart or for the presidency side of the house on Iran. So the fact that this is actually a solid effort coming out from them, I think is a really good sign right now.
From who? Because I know the Iranian president tweeted the MOU, but the Iranian president most normally, historically, focuses on domestic issues. Who is really the decision maker?
Well, so, I called it a four-headed hydra before. When you think about it in terms of supreme allied leader, from the theocratic side of the house, you also then have the presidency, you have IRGC, and then you also have members from the Chief Justice side of the house. So really all four of them have to speak in one. But the fact that what we haven't seen when the president was putting this out is we haven't seen something that's come back from the IRGC or somebody else that is actually refuting what the president put down. And they've had a little bit of time to do that at this point in time. I would have expected it by now.
Yeah, this is the new supreme leader that said the only place for Americans in the Persian Gulf is at the bottom of its waters. How serious can we take that this is going to be a strategic win for this administration, given the red lines this president has talked about for years?
I think one of the biggest pieces there is there's always going to be some type of messaging right there. It is part of the way that that Iran actually leverages power is to be able to hold on to that specifically. But in terms of the military side of the house, you've seen most of what the U.S. has done to their military capacity. It is more on the asymmetric threat that is remaining. That is still part of the piece that needs to be dealt with over the next 60 days. So from a strategic win on the U.S. side of the house, opening up the Strait of Hormuz right now is one of Trump's probably biggest ones he's going to be able to put out, dismantling their military so that their ability to come out and reach the United States to protect the homeland, I think is another one of those key pieces, as well as the Gulf state security. And you've seen a lot of that coming from Saudi Arabia, UAE, and Kuwait and beyond.
When we look at asymmetric warfare, how long do you think it's going to take for the United States and its partners to demine the strait?
So that's a very difficult one because of right now, a lot of the reporting is that it's not that heavy. And if you look at a lot of the capability that Fifth Fleet has brought with them, they have both uncrewed surface and undersea vessels that actually do a lot of this. They also have additional aerial capability. So what you're going to probably see is a phased approach to make sure that you have a clear channel within the channel, if you will, so that they can immediately come in and say, all right, here is the area that you want to stay within. And then they will slowly be able to start bringing it out. But you're going to see that initial piece. As you saw, some of the tankers are already starting to flow through, so it's going to stay. When CENTCOM and Fifth Fleet started talking about it taking multiple weeks, if not months, they're talking about making sure confirming the entirety of the strait, even the areas that aren't being traversed by the tankers.
Colonel Sanders, from a military perspective, what happens during this ceasefire? I mean, it's more than that. It's a memorandum of understanding, but it's a 60-day pause where both sides can take stock of the situation. Do you expect a rejigger in some of the ammunition production? Do you see some sort of shifting around of troops or returning to the U.S. by some of the naval operatives that have been on the water for months?
I think what you're going to end up seeing, who rotates home potentially after 30 days, right? I think that right now everybody's a little reticent to be able to pull back too far in terms of what you're actually going to bring back. But you're going to see some of your surge capabilities come home. You're not going to have 3 strike groups stay. You probably see some of the extra carrier wings come home, some of the strategic bomber fleets. But a reminder to everybody, though, Fifth Fleet's headquarters is in Bahrain, right? So the naval presence, a lot of it is still going to be around in that area in case something went wrong. There would be a very quick redeployment. You wouldn't have to see a surge of those strike groups to be able to come back. Continued intelligence assets, as well as fighter jets to keep air superiority. Those things remain because we have such a large presence from the U.S. We have a large presence across some of these Gulf bases. So there's still going to be quite a bit in the area.
Colonel Wayne Sanders of Bloomberg Intelligence, thank you so much for being with us this morning. And as we're talking, the oil prices and gasoline prices for average Americans continues to fall below $4 a barrel for the first time going back to March, 3.999% on an average basis across the nation. This was, some speculated, one of the key red lines for the president, which was getting oil prices lower ahead of the midterm elections and providing one of the last-ditch efforts at stimulus into the market.
Well, it's why everyone thinks potentially he got rid of some of the other red lines he has in terms of their ballistic missile program that is not explicitly addressed in this, as well as money to proxies, because he's so concerned with oil prices and energy prices moving higher ahead of the midterm elections. And it's not just that today we're seeing vessels being able to move with their transponders onto the Strait of Hormuz. In the MOU, the U.S. will issue waivers for Iran oil exports soon after the deal. So basically, potentially, we're going to see a statement in the next few days from Treasury's OFAC that allows Iranian crude to hit the market, which will bring prices potentially down further. It's pretty astonishing to see, given the fact that this was an administration that was obsessed and kept pushing for maximum pressure on this regime.
When you push that through the economy, it's unclear exactly how that's going to go. On one hand, there are stories about prices increasing throughout a whole metric of different places, including what we're seeing with respect to Apple. We'll get to that in just a little bit in terms of component prices and memory costs. On the other hand, we're looking at retail sales that have been pretty robust across the board. How does this factor into employment? We're going to be getting jobless claims. We haven't even mentioned that in our time because, frankly, the Fed seems less concerned about what's going to be happening in the labor market.
Well, how many times did Kevin Warsh say price stability and we will get back to 2%? Well, then you have to think inflation's coming from elsewhere. And you look what Apple's doing. What did Dan Ives say this week? Compute is the new oil and gas when it comes to that pricing, how critical it is to the economy.
Yeah, we're going to be getting those jobless claims right ahead of the Knicks parade, which also is going to stimulate the U.S. economy. Coming up, Anastasia Amoroso Partners Group as markets react to the Fed's hawkish hold, plus Vonnie Quinn with your morning movers. Intel climbing with the support of President Trump. There is some heat to this market. No thanks to the Federal Reserve. That's coming from oil prices falling. Take a look at stocks. You can see the outperformance coming from both what we see in the tech sphere as well as the Russell 2000. Futures up by about 1% on the Russell 2000 and 1.3% on the Nasdaq, just fading a little bit ahead of the open. It's the S&P futures up 0.7%. The bond space, fascinating. Yield curve flattening to the tune that we haven't seen in a couple of years. Really marked yesterday with a hawkish tilt continuing this morning. The 2-year yield up 2 basis points to 4.2%. That long end coming in. So that's where the flattening comes into play. Yesterday, the 13 basis point increase on the 2-year yield was the most for any Fed meeting that day going back to 2008. But really, sucking the oxygen out of the room, not just the Knicks, but also oil prices, where you do see them falling yet again to the lowest since the beginning of March. Brent crude $78.70, down about 1%. WTI down 1.5%.
Vessels are starting to go through. The MOU says that we're going to have waivers on Iranian exports. This is all healthy to get more oil barrels to the market right now, especially in places that have been dealing with demand destruction. A viewer writes in and says, is it plausible that promised lower oil prices from the MOU, with retail sales and employment already healthy, will be net stimulative, aka interest rates stay high?
Well, this to me is going to be the key question. How much has the inflationary push come truly from oil prices versus myriad other areas? We're talking about retail sales that have been doing pretty well outside of gas and automobiles. We're talking about people buying blue and orange. We're talking about people buying mugs. We're talking about people who are not going to the parade somehow, even though they've come out and worn every single part of their outfit that's orange and blue.
The Knicks are, and I'll stop doing this because, again, like I said, I can't have people thinking I'm a Mets fan. Once the Knicks excitement gets over, definitely not. And also, did you see yesterday, just quickly, Jalen Brunson, Josh Hart throughout the first pitch at Yankee Stadium? That's where they chose. That's where they chose to go. But World Cup, Knicks, seriously, all of this is very stimulative to the U.S. economy, regardless of potential inflation from gas prices.
And potential inflation from ticket prices. 2 hours away from the cash open, here are your morning movers with Vonnie Quinn. Vonnie.
Well, Lisa, it might be an up market, but we'll start with a down stock, and that is Accenture. Now, it did beat in terms of profit, but it cut its revenue guidance, and it continues on this acquisition spree. The latest, 3 more companies in the cybersecurity space. Obviously, its core business is getting dinged from AI concerns, investors dinging it as well, and it's continuing to try to pivot. But again, today, with that revenue guidance cut and the news that 3 more acquisitions are going on the books, this stock is down by 12-13% in the pre-market. Let's take a look at Intel, though. That is having a very different day, and we'll look at that in a moment. First, we'll look at the memory chip makers. Tim Cook gave an interview to the Wall Street Journal in which he said, look, we're going to have to finally put up prices on Apple products. Now, he declined to say when, which products, or by how much, but he basically said the reason was memory chips and storage are costing Apple a lot more money, and it's unsustainable. He has to pass some on to consumers. Well, that's good for margins, right? It means that there's pricing power for these memory chip makers, and those stocks are benefiting today, particularly Marvell Technology, which have been down a little more than the others. And finally, let's look at Intel, because it's again an Apple story. The president tweeting out that Intel was going to get into partnership with Apple on domestic chip production, a little bit like the NVIDIA Elon Musk Terafab partnership. And that has Intel stock rising. Of course, Lip Bhutan has been trying to find clients. If Apple were to be a large client, it would bring in a lot more. And that's definitely positive for a stock that's already risen 4-fold since the U.S. took an investment last August.
Thank you so much, Vonnie. On our radar this morning, the U.S. and Iran signing an interim deal to end the war and reopen the Strait of Hormuz. Iran's president publishing the text of the agreement on X, calling the deal historic. The Federal Reserve holding rates steady. Chair Kevin Warsh vowing to curb inflation and receiving support from President Donald Trump.
It's all right. Whatever.
And it looks like they might even raise them later this year. It's not clear. Do you have any
It
comment
could
on that?
happen. I mean, it's hard to believe. It just keeps a country down, you know. So it's so unusual. But we have a very good guy over there now, so I'm guided by what he wants.
Whatever, whether he raises rates or doesn't. Fed Chair Warsh avoiding giving any signal on his preferred rate path, but new projections showing many officials expect to raise rates at least once this year. And on the inflation story, this to me really stood out. Apple planning to raise prices to offset the surging cost of memories and storage chips. Outgoing CEO Tim Cook telling the Wall Street Journal, quote, price increases are unavoidable. Cook declining to offer further details or timing or scale. But again, this pressure is not just oil prices.
Right. And how do you maintain a profit margin if you're one of these companies, if you're seeing such sky high prices when it comes to memory and storage chips? On top of this interview you did with the Wall Street Journal then turned around and said, well, how much could the iPhone 18 Pro cost? Because everyone's thinking that's probably where there's going to be this increase in prices. $1,299. $1,300 basically for a brand new iPhone when that comes out. That's a lot of money.
This, though, also speaks to what we're talking about with the build out of technology and how that's going to cause inflation that does come into consumer goods in other ways.
can't escape it.
You can't escape it. And the iPhone is something that increasingly is a staple, whether you like it or whether you don't. And so this is one pathway to see some of the build out and the investment come into other inflationary inputs. Can people take some of what they're saving on gasoline prices and put it into their new iPhone? Maybe, but then it goes to the point of rates staying high regardless of oil prices coming in.
And it's not just iPhones. It's going to be the PCs and the MacBooks as well. And Morgan Stanley estimates a 15% bump for this across the year in the U.S. when it comes to not just the iPhone, but the other products. That's a lot of money. And yes, speaks to why Kevin Warsh is talking about price stability and not just focusing on energy prices.
There's a task force for that. Let's turn back to the Fed. Investors taking in the central bank's hawkish hold and pricing in a hike by October. Anastasia Amoroso of Partners Group writing, we wouldn't be surprised if expectations for the number of hikes and cuts flip many times between now and the fall. A big pencil with a big eraser. Anastasia joins us now. Anastasia, great to see you.
Good morning.
Good morning. What was your takeaway from yesterday?
Oh, look, the market's takeaway was that this is clearly a hawkish message. I don't actually think so. And the reason for that is all the task forces are designed to buy a whole lot of time. And, look, there was sort of a dismissal of the dots. He specifically talked about them being really penciled in based on the current information with a big eraser. And there's this allusion to the fact that a lot can change in the next 6 weeks. So I think it is a premature conclusion that we actually have a hawkish bias. There are other things that really stood out to me during the press conference. And one of them is a conversation about alternative data or the real-time, real-world contemporaneous data. I think that is really, really important. And I'll give you one example. If you look at the shelter inflation today in the CPI reports, then you'll see 3% roughly year-over-year change in shelter inflation. When you look at Zillow, CoStar, and others real-time data sources, you actually are seeing between negative 1% and maybe positive 1% or so. So a very different picture. So the question is, what else might we be overstating by relying on some of the backwards-looking surveys? And then the last point kind of to make on that is, Lisa, you talked about the price of semiconductors. And one thing that Kevin Warsh said is, look, we can't control, if I'm in a grocery store, I can't control the price of milk or eggs or oil and perhaps semiconductors. So maybe, just maybe, the committee is likely to look through some of those one-off increases that they can control. But what they can control is the secondary impacts, and that's most likely looking at services and wage inflation.
I hear you. The one caveat being, in terms of the hawkish tilt, is the narrow focus on inflation. That the Fed has not achieved its 2% target for 5 years. And so this has to change. This is something they can control and they need to lean into. And they didn't even mention the dual mandate of the employment market. Why is that not unabashedly hawkish?
Well, let's think about what drove inflation over the last year. It is a set of one-off factors. It was the tariff increases and the core goods increased as a result of that. Then is the energy prices that also increased, and then is some component of the AI tech trade. But when you project that out, if you model that out through the back half of the year into 2027, some of those one-off factors are likely set to roll over. Core goods inflation, for example, if you look at core goods, the last CPI report that we got, month-over-month change was negative. That was the first time we saw that in about a year or longer. So that's already sort of a positive forward-looking sign. Then you look at energy. We were looking at $120 barrel of crude oil. Today, the forward strip is $75. It is a vastly different picture. So I think that's going to trend down. And maybe the stickier component is going to be the semiconductors and software. But if you take all of those one-off factors in aggregate, that's about 1% that has been added to core inflation because of those things. But if they're going to diminish, the significance is going to diminish into the back half of the year, maybe that doesn't actually call for rate hikes. I will say, though, Lisa, 3.5% range is probably where we're going to be for some time.
Do you think he was just managing inflation expectations?
Yes. Yes. I mean, if you were an incoming Fed chair and, you want to make a very strong statement, and I think it was the exact right statement to make, the commitment to the inflation mandate. And as a result, Lisa, to your point, you have seen that yield curve flattening, and that's kind of constructive because that manages the 10-year part of the curve as well. Now, for us, for example, as private markets investors, while short-term rates are important because you do have some floating rate exposure, let's say in private credit, or for the portfolio companies, if you think about infrastructure assets, if you think about data centers, if you think about real estate, a lot of the valuations of those and the loans that they may be undertaking are tied to the 5-year part of the curve. So I see that actually net as a positive development.
Do you think also he had to come out and say this because of the fact he's entering a Fed? He was an inflation hawk in the past. He said in his hearing, inflation is a choice. Was he kind of almost trolling his predecessor who, for 5 years, they haven't hit their target?
Well, I mean, maybe it came across that way. We can't be the judge of what he really meant by that. But I think as an incoming Fed chair, he was there to reestablish the mandate and, to focus on the battle at hand, right, which is still inflation. If you look at the labor market, the positive thing there is the labor market has actually been reaccelerating, and we printed something like 166,000 jobs on average over the last 3 months, and that's the best level that we've seen since 2024. So there's not an emergency state in the labor market. While inflation, the core PC, is still running at 3.3%, that sounds a lot more urgent. So I understand the focus on that.
I want to pick up on the point about private markets and that being more hawkish in the near term leads to more value on the long end, with the idea that you could see yields come in. Does this actually encourage you to take more risk when it comes to housing sensitive or building sensitive types of sectors?
I think in parts, absolutely. I'll give you one example, which is the data center business. When you think about how you price a data center, you price it of your operating income, and then you discount it by the cap rate. And the cap rate is a function, of course, of what the base rate of what the rates are in that part of the curve. And to the extent that lower rates across the curve can translate into lower cap rates, all things equal, they mechanically lift the valuation of things like data centers, for example. So that's certainly supportive. If you think about real estate and parts of and infrastructure, there's leverage that's undertaken to build a data center or to build a commercial building. So to the extent that the leverage costs come down in that part of the curve, that's also supportive as well. So I would say yes, constructive there. When you look at some of the private equity businesses and the leverage buyouts, they may use more short-term floating rate debt, I should say, which is tied to the short-term rate. And, certainly it's not great news that we're not going to see as many rate cuts there. But I will say, Lisa, for our portfolio companies and in general, the coverage ratios have improved significantly versus what they were in 2022. So the cash flows have improved as well. So it's actually most meaningful for the private equity companies is the EBITDA growing, or is the profitability growing? And for us, we do see that acceleration in EBITDA growth from last year into this year and into the following year. So I'd say that sort of trumps some of the rate considerations.
Anastasia Amoroso, thank you so much for being with us this morning.
Thank you.
Anastasia Amoroso of Partners Group, as we look at the hawkish tilt having maybe dovish consequences in the long end of the yield curve. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Isabel Lee. Isabel.
Hi, Lisa. Federal Reserve Chair Kevin Warsh announced 5 independent task forces. During his first press conference, Warsh said the groups will be responsible for fundamentally rethinking key elements of central bank operations and monetary policy. And Apple is preparing to release the second generation of the iPhone Air. The new model added a second rear camera for ultra-wide-angle photography and improved battery life. The model is expected to release in spring of next year. And gas prices dipping below $4 a gallon for the first time since March. According to AAA, the national average for regular unleaded is now $3.99. Prices are still well above where they stood before the war and aren't expected to return to those levels until next year. That's your Bloomberg Brief. Lisa?
Thank you so much, Isabel. Up next, reforming the Federal Reserve.
I'm appointing a task force in each of 5 areas. That'll be taken up by the task force. We've got a task force for that. I've been on a task force or 2 in my life. It's one of the things we have a task force to do.
Former Kansas City Fed President Esther George joins us next to answer the question, is she on the task force? From New York, this is Bloomberg Surveillance. Can you be not dovish, but send rates lower with being hawkish. Right now, even though we had a real shift in tone from the Federal Reserve, you are seeing risk on continue with the long end of the yield curve coming in. This morning, 0.6% gain on the S&P. 10-year yields lower by 3 basis points. Dollar stronger, crude lower as that MOU gets signed between the U.S. and Iran. Where does the Fed fit into this? Under surveillance this morning, reforming the Federal Reserve.
I'm appointing a task force in each of 5 areas. You'll hear quite a bit more about these task forces. That'll be taken up by the task force. We've got a task force for that. The good news for you is we have a task force for that. We have a task force on that too. I've been on a task force or two in my life. It's one of the things we have a task force to do.
Here's the latest. Fed Chair Kevin Warsh appointing, guess what, new task forces, saying professionals inside and outside of economics will review 5 areas central to monetary policy. Former Kansas City Fed President Esther George writing, uncertainty will heighten as to how the outcome of these reviews might refocus the FOMC frameworks and processes. Esther joins us now. Great to see you. Thank you for being with us, Esther. Let's just start off. Were you asked to be on any of these task forces?
Well, there's plenty of opportunity with 5 of them, and I will stand by waiting for the call.
Were you surprised by anything out of yesterday's press conference?
So I don't know that I would call it a surprise, Lisa, but I do think what we were waiting to hear and what a new Fed chairman would be expected to do is sort of establish the tone. And the tone, I think, came through loud and clear with the emphasis on price stability. And of course, the other thing people were waiting for is how exactly will the changes that Kevin Warsh foreshadowed play out? And of course, we saw that again in his explaining the task forces and what they would be assigned to do.
There seemed to be a de-emphasis on the labor market, this idea that you can have a dual mandate and that mandate can come into conflict. He answered and said, really, he doesn't see it that way, and it's not really the right way, given the fact that if you have price stability, that fosters a robust economy that can allow full employment. What was your take of the fact that he really de-emphasized one side of the mandate?
Well, I think it has been highly emphasized in the past for sure. And that has not always been the case in the history of the Federal Reserve, even with that dual mandate. The research, too, I think would support essentially what he's saying, which is if you achieve price stability over the long run, it really sets the conditions for a healthy labor market. So certainly a contrast, I think, to what some of the messaging has been even over the past year. But I don't expect that either undermines the mandate nor the focus that this committee has to have, which, as you noted, squarely on the inflation issue that they've been wrestling with for a number of years.
It feels like Kevin Warsh is a minimalist when it comes to facts only in the statement, not a lot of forward guidance. In that sense, do you think that is clear communication, or do you think it creates more uncertainty for financial markets?
Well, you're right. I think it can have more effects because the point is not the number of words that you're using. It is really the clarity with which you're expressing what you're trying to communicate. And that, of course, will be the challenge, I think, going forward. One could argue there's been a lot of communication and maybe not the right amount of clarity. And I think if you move to the other end of that spectrum, which is let's shorten it up, let's be more concise, also leaves a lot of room for misinterpretation too. So again, I think this focus on communication is a good one. I think it's one that FOMC has looked at over a number of years, trying to figure out where do you get the bang for your buck in the communications you're trying to deliver. And again, he has a task force for that, so we'll see where they come out on that.
Well, will other members of the committee line up behind him and when they give speeches, refrain from talking about forward guidance?
Well, we'll have to see. And I think we'll get a chance next week. There'll be some of the FOMC participants will be out speaking. Remember, when Fed presidents, which I can speak to most directly, go out, they are out there in their regions really trying to explain policy to people. I think this committee is always operating with a degree of deference to the chairman. I think they're willing to let the direction be led here, but they will have to speak about their views as they go out. And again, their view I think if we can look back to the past meeting, the past year, and how they've communicated and have clues about how they're thinking about the policy path.
Our resident Fed expert wrote in to let us know of your prominent position for the World Cup committee in Kansas City. And this does play into inflation. There's a task force for the World Cup committee. I can say that I saw some of the Argentinian fans lining up to get on a plane to go to Kansas City, all decked out in blue and white, incredibly excited. I'm sure you're incredibly excited and have great seats to the game. I'm wondering, from your perspective, how do you see it as representative of the strength in the consumer? I mean, how much is this an increasingly economic story as well as one of incredible fandom for the soccer sport?
Well, we're excited here in Kansas City about our connection to the World Cup, and the Argentinians. The Algerian game was an exciting one for sure. I think, Lisa, your question really speaks to how is the consumer doing today? And we do see consumer spending strong, retail sales are moving. And I will tell you, the seats were full at the stadium where I watched that game. So there is spending going on in the economy today, which, of course, is why the FOMC has to be particularly attentive to its mandate around price stability, that they have to follow through, again, I think, as we heard yesterday, on that mandate.
Do you think it would be advisable for them to hike rates later this year?
Well, I think there's a good argument to be made for that. And of course, I think what we heard yesterday is we're not going to prognosticate about that, but we're going to watch the data carefully, which of course is what the committee has to do and has done for some time. But when you look at the persistence of inflation, notwithstanding that we see some good news coming out of the oil markets, there has been an underlying issue with inflation being sticky. And so looking at whether the current interest rate is going to be sufficient to bring that back to target, I think is a real question and one they're going to have to tackle.
Former Kansas City Fed President Esther George, thank you so much. And good luck throughout the World Cup, given the fact that I really did see an incredible rush of people heading over to Kansas City.
Of course, because you get a chance to see Messi, right? Didn't he have a hat trick in that game? So pretty incredible and probably worth buying the tickets for, right? Because some of these games, a lot of people view are just once in a lifetime, so you're going to pay up.
All I can say is that the Mets are single-handedly trying to disinflate some of those ticket prices as a result of their their results. So it's not even across the board. Some pockets of strength.
But New York's getting evened out with the Yankee ticket pricing, and obviously, I mean, the Knicks tickets were insane. Before I decided to go to Game 5, I checked Game 6 ticket prices. Get in price, worst seat in the arena in MSG. $11,000.
Just a programming note. This is the last day that Annmarie is allowed to talk about the fact that she did attend Game 5 of the Knicks. Coming up next hour, Scott Chronert of Citigroup, Charles Schwab of CEO Rick Wurster, Claudia Sahm of New Century Advisors, and Jessica Noviskis of Marquette Associates. So we see risk on reassert itself with a deal signed between the U.S. and Iran, a deal a day early from New York. This is Bloomberg Surveillance.
The committee decided to maintain the target range for the Fed funds rate in support of the Fed's dual mandate.
This was a very deliberate and patient approach, and we'll see through the path of incoming data how this plays out.
It's hard not to interpret that as a little bit more hawkish than otherwise people might have expected.
Half of the committee is expecting rate hikes this year. We were thinking 2, maybe 3 to be decorative. We didn't think half the committee.
That's one of the challenges the Fed faces is they've got to manage to the economic aggregates when the devil is in the details.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Good morning. Welcome back to Bloomberg Surveillance on a Thursday that feels like a Friday. It's tug of war Thursday with two competing factors buffeting markets. On one side, stocks rising on the prospect of a signed deal between the U.S. and Iran. On the other, a bold new Fed chair, Kevin Warsh, putting a hawkish stamp on the world's most important central bank, locking in market expectations for a rate hike as soon as October with a really hawkish projection from the committee. For the moment, traders taking more signal from falling oil prices than potential rate hikes and almost shrugging off the jobless claims that we get in 30 minutes time.
Because the Fed has told us they are focused on price stability. And what we see right now in financial markets and also bleeding through the real economy, Oil prices are lower. Gasoline is now under $4 a gallon. This is what this White House wanted to see ahead of the midterm elections. I love what Roule talked to us about when it comes to this deal. The reported U.S.-Iran deal is best understood as a high-value pause in the current military phase of the conflict, not a durable strategic settlement. We're seeing all this good news. It's for 60 days. What happens next?
At the same time, you are seeing oil prices come down, and it's not just on the front end of the contracts, it's also on the longer end. When you take a look at the December contracts, some of the lowest levels that we've seen since early March. Does the Fed have an easier time, and do central banks around the world, given that there is this reprieve in oil prices? Maybe, but we were talking about last hour how Apple is going to be raising prices as a result of the memory component. So how broad-based is this inflation? How much can the U.S. labor market truly support the ongoing spending?
And I love what Michael Purvis just wrote in. Is Warsh the hawk who keeps rates lower? He's coming in very hawkish. He's setting a new tone. He's not putting a dot on the plot. He's issuing less words in the statement. He is certainly setting a new tone, but how much is that just to manage inflation expectations so it doesn't get out of control and potentially at some point be able to deliver on what this White House wants to see, which is an interest rate reduction? Time will tell.
Whatever. That's the response from President
Trump. Salty,
seeming
no?
a little bit to take the pressure off. Right now, taking the pressure off in equities and giving it some juice, in particular when the tech trade seeing a rally across the board, led by the NASDAQ, 0.7% gain in S&P futures. You're seeing yields lower on the long end. Are you potentially leading to easier financial conditions at the long end by being hawkish in the near term, 4.46%? On that denomination, and crude lower by about 2% on WTI at $75.30. Coming up this hour, Scott Chronert of Citigroup with tech leading stocks higher, Charles Schwab CEO Rick Wurster as SpaceX shares pull back after historic retail demand. And Claudia Sahm of New Century Advisors as Fed Chair Kevin Warsh kicks off a new era for policy. We begin this hour with stocks bouncing back and oil falling as markets digest a hawkish Fed with a peace deal in Iran. Scott Chronert of Citigroup writing, the Citi House view remains for 3 cuts starting in September. Our S&P 500 8100 year-end target is not predicated on lower Fed funds. That said, tightening from here would certainly put some pressure on our views. Scott joins us now for more. Scott, I just want to welcome you and get your take on what we heard yesterday to see if you think that's enough to shift your likelihood of a potential rate hike as significantly higher.
Hi, Lisa. Good morning. Well, I'd say, our economist view is that there's still a likelihood for Fed cuts later in the year. Overnight, they pushed their expectations out to a first cut in October from the previous September. So now I think we're officially looking for 2 cuts between now and the end of the year. So, we incorporate that into our U.S. equity views in a number of ways. But I'd say first and foremost, it plays to how we think about the broadening dynamic within U.S. equities. Like heretofore, we've been very, very adamant of the view that we're actually having to make 2 market calls here. One on the AI-related cohort that is now approaching 50% of index earnings. The other on everything else, which is where your more traditional macro issues come into play. So we'll navigate this. I think what we got out of Warsh in hindsight was not a surprise given his inflation hawkish background and perspective. And also just we need to allow, as we've talked about, it seems like several months ago, that as you got into new Fed chair mode, you had to prepare for some volatility around the change in the language and the commentary.
Did oil steal Kevin Warsh's thunder on some level, given the fact that the decline in oil prices gave potential stimulus in its own right to the consumer-facing sector to maybe support some of that broadening out?
I think you highlighted earlier, we've been all in on the focus on the futures curve for crude, and there you're seeing a fairly dramatic, downward sloping pattern unfolding here as we've gone into this latest Iran negotiation. So I think we all, are quizzical on will it persist. The oil markets are telling you that they expect it will persist, and then the question becomes one of, well, were the Fed members in a position to adequately address the potential impact of this now falling oil price? Our suspicion is that as we get further into the fall months, you'll see this balance between signs of inflation coming in, some nagging labor concerns creep in, probably keeps the Fed on pause for now. Certainly, to our team's view, until we get a little bit further into the fall months.
But Scott, given the fact that Federal Reserve Chair Kevin Warsh continuously talked about price stability, he was talking more than just the rise in energy prices. Isn't he seeing inflation elsewhere?
Well, I think this is one of the issues when you get into the details on a lot of the inflation data. It's like, okay, what's the force driving the data this month? And sometimes those forces can be fairly narrow as opposed to how you think about it in a more classically broad-based approach. So I think we just have to be aware that, as we've said earlier, that Mr. Warsh's views coming in kind of started out with a hawkish inflation bias. I would say that I think, identifying that 2% target, I thought was pretty telling in terms of setting the tone for this. He's making it clear he's not going to let this inflation issue get away with from him. But I do think that there's still a lot of wood to chop here in terms of how the Fed's going to go through their process, how they're going to evaluate all the puts and takes. And we'll see. I know the markets are leaning incrementally hawkish in terms of timing for a next Fed rate hike. And we'll have to navigate that as a source of volatility. For now, not changing our U.S. equity views, which are still net constructive as we enter the second half.
I love your take as well, just from your position in terms of an equity strategist. Does it matter to you? Were you interested in knowing more about these task force, or you just read them as this is a Federal Reserve Chair who's buying some time?
Well, I'm not an economist by trade. We follow this pretty closely, obviously, and I think the task force makes a lot of sense. And I think, taking a fresh look at the Fed process was something that we expected from Mr. Warsh all along. And I think that's terrific. I think one of the issues that, we've been kind of, dealing with over the past several years is a Fed that seems so data dependent that sometimes it puts itself behind the curve in terms of reacting to events as they unfold. And sometimes that can be to the detriment of both economic conditions, in many cases, U.S. equity fundamentals. So, again, I welcome the refresh. We'll see where this takes us. I think it just probably says that, hey, again, just be prepared that the Fed messaging is going to be a little bit different than it's been as we go into the next couple of meetings from here.
Scott, I love how you framed the different market calls, the idea of the broadening out trade in the economy versus the AI trade, which seems somewhat independent of everything. Given what we've seen from SpaceX, given what we've seen in terms of the attention being paid to the mythos and fable iterations of Anthropic, given how central the AI leaders are to the entire G7, do you only see this particular trade continuing to gain, or are you starting to see some cracks?
Well, I think we know that the supply that's coming and is expected to come via issuance is an early sign that we have to pay attention, okay? And this is something that we've called out. A lot of this is a double-edged sword. You want the funding to support the investment. On the other hand, the funding leads to share price dilution, and there are other nagging issues that come with that. So we know that also, and this has been part of our recent view to take our S&P target up for this year to now 8,100, is that what this is driving is let's call it an AI CapEx super cycle that we think we're still in the middle innings of. So essentially the setup here is for an expectation that we see fairly consistent beats and raises out of that part of the market, certainly in Qs 2, 3, and probably 4, and we'll have a fairly positive view of going into 27. Beyond that, it gets a little bit more murky, I would say. And so I think we have to look at some of the earnings tailwinds that we're getting here out of the AI play as here for now, part of this CapEx super cycle, but we have to be wary that it's not going to last forever. On the flip side, the broadening call has always been about getting back to where we started the year, which was for sort of soft landing conditions with expectations for a somewhat easier Fed that allows other parts of the market to re-engage. We haven't seen that in their fundamental follow through thus far into the reporting cycle, with Q1 results not showing much change in the forward earnings picture for that other half of the index. So, we've got a couple of hands that we're playing here. We think the best opportunity for a market, hitting persistent new highs is going to be a combination of those two forces at work.
Scott Chronert of Citigroup, thank you so much for taking the time this morning as we parse through these dueling factors. I love that, these different markets that seem completely divorced from one another. Right now, let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Isabel Lee. Isabel.
Hi, Lisa. Iran's president publishing the text of the interim deal between Tehran and the U.S. on X. Some of the details include traffic of commercial vessels through the Strait of Hormuz to start immediately with no charge for 60 days, as well as the U.S. fully ending its naval blockade in 30 days. And the BOE holding interest rates steady at 3.75%. The central bank saying the recent drop in oil prices is, quote, encouraging. Two policymakers voting for an immediate quarter-point hike due to concerns over persistent inflation. And a historic day in New York, the Knicks getting their first ever ticker tape parade. The parade through the Canyon of Heroes is kicking off at 10 a.m. Eastern and is expected to draw millions of fans. Some fans paying as much as $950 for professional line sitters to secure a front row view. That's quite a price. That's your Bloomberg Brief. Lisa.
Thank you so much. A word just to all of the bosses out there. If your employees are a little bit late, they might be stuck in the subway behind a lot of different uniforms.
How many people are also just calling in sick? It feels like once in a lifetime. Yeah.
I hear a little bit of raspiness there. I think
I'm on TV, so obviously I'm not there. But also, can you imagine paying $950 for a professional seat holder? That's not a bad gig.
Oh my God! Are you thinking of
maybe on the weekends?
All right. Well, this is a once in a lifetime thing, and maybe Annmarie is rethinking her choices. Up next, the morning calls plus Charles Schwab CEO Rick Wurster on the blockbuster run for retail investors following the SpaceX debut. That's kind of wage inflation, right? I mean, that really caused some increase in spending capacity.
Yes. Maybe that's where John is today.
Ooh, I highly doubt that. That conversation is not coming up next. Rick Wurster is. This is Bloomberg Surveillance.
With any model, with any technology, there's going to be a risk of harm. Executives, companies are realizing they have to prepare both for the benefits of AI and also making sure things like their cybersecurity are up to date. Models like this can improve cybersecurity and identify potential attacks that can actually allow companies to respond to those quickly rather than having those vulnerabilities exploited.
That was Jennifer Huddleston of the Cato Institute on potentially finding some of those holes. Of course, it is a timing mismatch. How long does it take to patch up some of these holes as you find those vulnerabilities? Right now, people looking through some of all of the concerns, seeing some gains in risk assets, 0.7% gain on S&P futures, yields lower on the long end as people take a look at a potentially more hawkish Federal Reserve raising rates in the near term to lower inflation and benchmark rates in the shorter and in the longer term. And crude prices really in the front seat here, down 2.4% as we look to a deal between the U.S. and Iran. Time now for the morning calls. First up, Wedbush more than doubling its price target on Micron to $1,300, saying estimates for revenue and EPS have increased substantially. Those shares surging 4.5%, though some of this is also some sort of rebound from some of the sell-off that we've seen in the past couple of weeks. Next up, KeyBank raising its price target on Marvell to $385 from $280. The analysts saying networking should increasingly be a focus for investors. And finally, already initiating coverage on SpaceX with a buy rating and a street-high $401 price target, saying the company is breaking down hard engineering challenges into stepwise tasks as it builds scale into space. SpaceX seeing historic appetite from retail investors, drawing over $370 million in demand since Friday. Charles Schwab was one of the firms that brought the listing to Main Street. Joining us now, I'm so pleased to say, is the Schwab President and Chief Executive Officer, Rick Wurster. Rick, great to see you. Thank you for being with us. I want to start just with how you see the retail investors' role in this particular IPO and how it highlights, in some ways, a changed market.
Well, it's a breakthrough event, I think, for the retail investor who was allocated roughly 20% of the deal, which is triple a typical IPO. So it's great to see retail having a meaningful seat at the table. It created tremendous engagement with our clients and broadly with retail clients. Demand was off the charts, and that demand continues. We've seen in the 3 days following the IPO, nearly $7 billion of additional orders come from our clients alone. So lots of interest, a great breakthrough for the retail client having a seat at the table. It was great to see.
There's a little bit of concern in some corners, albeit with skepticism, because you never want to bet against an entire crowd of people who are going in one direction. But Rick, there does seem like it's more kind of in vibes and support of the ideas of things rather than traditional valuations. Does that concern you, or does that frankly give you faith in the crowds, the wisdom of crowds, rather than Wall Street analysis?
Yeah, it's tough to know with foresight what the returns will be, but I think what's so exciting about the market is the level of innovation that you're seeing. And the retail investor sees that every day in their life, and they want to be a part of it. And so you're seeing tremendous interest in AI-related names and the space names. I think it comes from the retail investor being able to touch and feel the level of innovation in our economy. And I think clearly they're holding names that are doing stocks that are doing well with really strong fundamentals. Exactly what the returns will be, only time will tell.
This was like a Super Bowl moment for financial markets, and we learned that there were war rooms you set up, various ones, and you increased your team. Can you just give us some color? Where were you during all of this? What was the vibes like in these war rooms that you set up?
It was a pretty amazing event in that it was one of the top 5 most active days for our clients in the 50-year-plus history of the firm. And if you think about all the market events we've had over those 50 years, for the IPO to crack the top 5 is pretty unbelievable. We had 140,000 clients call in live. We had lots of digital engagement. It was impressive to see, and our teams were fully staffed, ready, and able to handle our clients' needs that day. It was wonderful to see the teamwork and the effort that went into making this a success on our side.
How do you think this is going to establish potentially what's next when it comes to other mega IPOs like Anthropic and OpenAI?
Hopefully it establishes retail having a really strong presence at the table. I think it's wonderful for the retail investor to be able to participate in something like this. So I hope this IPO establishes that. I think it also establishes an incredible level of interest among our client base for new and innovative technologies and being able to participate them. We recently closed a deal with Forge, which allows our clients to invest in pre-IPO companies. And so I think that the interest around these new ideas and emerging companies is quite high and will only continue.
Charles, Rick, the point that you just made is actually really important, given the fact that people note that increasingly the value is being created before the IPO when companies are still private. Do you think that some of these IPOs will expedite the efforts to get access to retail investors into private markets through a whole host of different ways?
I do think it will expedite it because people will have interest in getting in earlier because these companies are waiting far longer to go public. And so there's a lot of value being created while they're private and people want in. I know on the Forge platform, these companies were brought with much lower valuations. SpaceX in particular, I think first came to the Forge platform when it was roughly $60 billion in value. And so those investors who were able to participate early at a $60 billion valuation are seeing it now well over $2 trillion and are enjoying the very significant returns that they had. And I think more and more people are getting to see and experience these companies that are private. They're benefiting from a lot of their technology, and they want a way to access the returns that are going to come from the innovation that they're driving. So I do think it'll create more interest in private companies, and we want to participate in that.
Rick, what's the demographic of some of the retail investors who have been most interested in some of these IPOs? And I ask that because it seems like there are some generational divides that have emerged in terms of who is more actively trading some of the zero-dated options and other instruments versus the 60-40 crowd that grew up in another era.
Yeah, interesting. We saw demand for this IPO across the demographic, from young investors to our older investors. So really high demand across the board.
Are you seeing your retail investors having to move money out of certain positions so they can get ahead of something exciting like the SpaceX IPO?
A couple of things. We saw in May more new money being put to work, so people taking money from cash, getting it invested. We also did see some rotation, and part of what drove the high levels of activity around the SpaceX IPO were clients who are repositioning their portfolio to free up money to invest in SpaceX. So I think it's a little bit a combination of both.
When you look at some of the other brokerage that are involved, Fidelity, Robinhood, E-Trade, why do you think investors should come to you? I know a lot of young investors are very excited about Robinhood and also how some of their software operates. Why for you, given the fact that this is going to be a massive summer for IPOs?
Yeah, I think Schwab is the place to be because we've got what we think is the world's greatest trading platform in Thinkorswim. We've got a research and education platform that is built with the client first, putting information and analysis in their hands to make informed decisions. And we have the support and service that can't be matched. We had 140,000 client calls, all from tell me what an IPO is to how do I actually purchase the IPO and how do I get involved? So I think at Schwab, you get full end-to-end service from a person that can help you, a great digital experience, a leading trading platform, and the research and insights that are going to put your interests at the forefront. So that's why if you look at our trading activity, we handle the most daily average trades, I think by double the next largest broker. So we do think we are the premier destination for trading in our country.
Just real quick, Rick. I'm wondering if the Fed is more hawkish and does raise rates, do you think that that's going to limit some of the profitability due to the contracting yield curve?
For the company or for
the company?
For the company, we're well positioned, and if rates rise, that's generally beneficial to our company. But we're an all-weather business model, and we've got three major sources of revenue: trading activity, asset management and fee-based revenue, and then revenue that comes from net interest margin. So we have a diversified business model, can handle, we think, a lot of different environments. But in general, with the environment that we're seeing around rates, that only provides a tailwind for our business.
Rick Wurster, thank you so much for being with us this morning. Charles Schwab, CEO, after the IPO that broke records and has rallied more than 40% since the first day of trading, even with a bit of a pullback yesterday.
And excitement for retail investors in something like SpaceX. Are we going to see that same sort of allocation, excitement when it comes to Anthropic, when it comes to OpenAI, when they hit the market this summer? And places like Charles Schwab are excited and hopeful for a second coming almost of another IPO.
Yeah, incredible competition to get a slice of this deal in any which way. We are just about 5 minutes away from initial jobs claims. Remember the jobs market? That's hard to sort of think about given how much inflation was emphasized yesterday. Do we get an increase similar to what we saw at the previous read? Plus, Claudia Sahm of New Century Advisors on the new era of communication at the Fed. There is a task force for all sorts of things. If you have been selected for the task force, please call in from New York. This is Bloomberg Surveillance. The rally extends this morning with oil prices falling across the board, giving some heat in particular to the AI trade. The Nasdaq 100 leading the charge out the gate, 1.6% gain in futures. And you can see the Russell 2000 right there behind it, 1.3%. The extra stimulus not coming from the Federal Reserve, but coming from oil markets. When you take a look at 2s, 10s, and 30s, it's yield curve compression. As we get some data on initial jobless claims, how much are we banking on some sort of ongoing strength in the U.S. economy and the labor market? Just crossing the numbers now, brought to you by Michael McKee. Mike, what do you see?
Well, what I see is Kevin Warsh gets a break. He doesn't have to worry about the labor market. Didn't talk much about it yesterday. It does seem to be stable. 226,000 initial jobless claims, and that's a decline from 230,000, which is revised up from 229 last week. Either way you look at it, it shows jobless claims relatively stable. They've moved up over the last couple of weeks, but not significantly. The country is still maybe not hiring. A few more people they are, but maybe not hiring in big numbers, but they're certainly not firing at this point. Continuing claims, 1,810,000 do rise from 1,786,000. So maybe some people are having a little harder time getting a job, but these are weekly numbers, so they do bounce around a lot. But the bottom line is it's not a major big deal. The Philadelphia Fed numbers are out as well, and the Philly Fed index rises to 10.3 from negative 0.4. The prices paid index is at 53.2 versus 47.9. So we still have inflation. That's no surprise given that we saw prices rise significantly during this war. We don't know how much or how often they're going to go down, but it does show business a little bit stronger in the Philadelphia area. So it does look like at this point the economy is in relatively good shape. And the labor market is in relatively good shape. So if you're going to be the Fed and want to take something on, it can be inflation.
If you take a look at markets, taking this all in stride, as expected, Mike, as you were mentioning, there hasn't been a huge shift in the expectations or the labor market in terms of reasserting itself as a primary story. In the bond market, you could see two-year yields actually come in just a touch on this data, but otherwise, across the board, staying pretty much where you were. The rally actually escalating on the 30-year yield at 4.86%, down 7 basis points as people take a look potentially to some weakening there. Mike, I wonder how much the employment data has been de-emphasized as a result of the statement that we heard from the Federal Reserve, unless it has to do with wages, which more directly feeds into inflation.
Well, there's no wage pressure out there, certainly, because average hourly earnings and other wage measures have been dropping, and they're now below the level of inflation. So if you're going to try to do something about wages, it's probably going to be bring down the inflation rate so that people can get ahead a little bit. I think they basically are saying, as long as the labor market doesn't show signs of falling apart, we're going to completely focus on the inflation side of the mandate. It's been something that's been growing for a while, concerned that they haven't hit the target in over 5 years, the 2% target. And it's about time they do that, or they risk the idea of inflation expectations getting out of control, people thinking that inflation is going to be always higher.
Michael McKee, thank you so much for breaking that down. As we see, that's kind of flatlined in terms of any kind of excitement coming from jobless claims, really indicative of the low hire, low fire environment that we're in. This is all going to be analyzed by a number of task forces. Claudia Sahm of New Century Advisors writing, I think it was a mistake by Warsh not to participate in the statement of economic projections. Warsh is leaving huge blanks in his communication. The dot plot's days may be numbered, but it was critical for credibility. Claudia joins us now for more. Claudia, great to see you. Always love getting your perspective. Let's start there. Why was it a mistake not to put a dot on that plot?
Right. Well, I think the statement ended with a very forceful, this committee will deliver price stability, which leads to a natural question of, well, how are you going to do that? Right? Like, how are you going to deliver? And the summary of economic projections, it is not perfect. It's often misunderstood, but that is actually the exercise of the dot plot. It's actually, each individual is like the FOMC. What is the appropriate path for federal funds rate? What's the right monetary policy to get us to the dual mandate? That price stability, 2% is where all of those forecasts end in 2028. That's because of they're working their way towards price stability, and they adjust their federal funds rate to get there. So they're like putting together plans individually. And Kevin Warsh didn't participate in that exercise, and he didn't flesh out in the press conference his views of what a plan could be of how to get to that price stability.
And this was partly by design, right? I mean, he talked about how he wanted the market to be one of the key metrics that they do look at, and that the market, he wants to have clarity of focus on the data without trying to interpret how the Fed would look at the data and then respond to the Fed's response to the data. I mean, what do you make of that argument?
I think it's going to be a tough sell. And honestly, I can, set aside, he doesn't want to talk about plans. He doesn't want to talk about the future. Okay, that's a debate to have about communication. But what was really striking is he didn't want to talk about the decision they made this week. I mean, they say they want price stability. They voted unanimously to hold rates steady. How is that in service of price stability?
Are you saying you think they should have hiked this meeting?
No, I think they should have explained why they chose to hold rates steady. I agree with that decision, but it's like totally pointless that I agree with it. I want to hear what the Fed chair thinks about it, what the committee thinks about it. Why was that the right decision? We know from the summary of economic projections that many of them think it's going to be appropriate to raise rates later. Many of them don't think it will be. Like, tell me about why you decided to do what you did today. It's communications also about accountability. Like understanding who these people are that are making these big decisions. They don't have a crystal ball, but I really do expect them to explain what they're doing right now and show their work.
Is it potentially that Kevin Warsh views as a slippery slope to then be an individual that's up there on the podium giving forward guidance, which he doesn't agree with?
Again, I don't, don't tell me about the future, but I feel like there's some hiding behind the jargon. And I will say, first press conference, right? Like this, unevenness out of the gate, totally understandable. But I do think there's room for adjustment. And if you just want to talk about the decision that was made today, fine, but do talk about that. And yes, I think it's important, the slippery slope, okay, fine. But the service of accountability is important. And we do need to, I think, have some insights onto the discussions that they're having and how they're weighing the data and what they're thinking about. Because honestly, right now, monetary policy is tough, right? So we should have some insights into the debate that they're having about those policies.
We're going to get more information about how they plan to communicate going forward. What's the potential consequence of this approach in markets? Is it more volatility? Is it just more uncertainty expressed in other ways? How do you filter this into being potentially pernicious in a way that maybe people don't understand?
Right, so markets are going to fill in the blanks. Right? They're going to try to come up with some views that's going to mean we're going to have more uncertainty about what the Federal Reserve is going to do, which is going to lead to potentially more volatility in interest rates. And investors are going to want to be compensated for that uncertainty, right? So it does come at a cost. And so, there's no free lunch here in terms of how the Fed interacts with markets. And, we had a Fed long ago that liked to surprise markets and didn't give a lot of information. And no, the recent regime may not be perfect, but we moved away from that, the Fed surprising markets, for a lot of good reasons. And I think backtracking into that could cause a lot of problems down the road.
We did learn something pretty crucial, and this added to the hawkish message that the market took from the statement, and frankly, the statement of economic projections in particular, which is that 9 of the 18 members of the FOMC saw the next move as a hike later this year. That's new, and that's significant. How do you interpret that, and do you think that that's the appropriate stance?
Right, and what those individuals are saying is not necessarily they expect hikes, but they think that's appropriate. That is going to be necessary to get us back to price stability. That's a really important statement. Again, I think we'll hear speeches, we'll get this fleshed out with individuals thinking, but they also said in the statement that, a big part of what's happening with inflation are supply shocks related to energy. The textbook is for in energy supply shocks, the Fed should look through it. The Fed shouldn't be raising rates into that. So it's telling you something to have a group of Fed officials say, we've had enough of these supply shocks. It's spread out over time. We need to be raising rates to rein this in, even if it goes against, the textbook response to one supply shock individually. That is a big shift in monetary policy, and it was a very divided committee. You had the other half not going down that route. So there's a lot going on in the committee in these debates, and, it would be nice to understand a little bit more about what the exact debates are. The dots are hard to read from the outside.
Speaking of the SEP, though, and I know you think it was a mistake for Warsh not to participate, do you think it's a signal that potentially the dot plot could go away one day?
Oh, it could, but you need, I think the tool, the communication is important. There may be a better way to do it. I think it's very helpful to get a sense of, how committee members react to data, how they think about weighing inflation or unemployment. Maybe the dot plot is not the best way to do this. I think the committee in their framework review were clear. There are some flaws with it, but nobody had a better idea. I think that's the thing is that, you just deleting information, deleting tools is not going to be very satisfying. Improving them is going to be awesome. So if Kevin Warsh can lead to real improvements, I think that'd be something to be excited about. But that's going to take time. And this committee has really thought hard about the issue. It's not simple to answer these questions, but we'll see where the task force and then the committee, how they weigh the ideas that the task force come up with.
Claudia, do you think that Jerome Powell will stay on for longer due to some of the scope of changes that are currently underway?
So I take Jerome Powell at his word that he is, his decision to stay on is very much tied with these concerns about independence, concerns about the building, the review of the building renovation. And so when he feels like, those issues have been resolved to his satisfaction, then I would expect him to go. I didn't see anything this is like a protest vote of Kevin Warsh. I mean, it sounded like everyone on the committee is really trying to set the new chair up for success.
Claudia Sahm of New Century Advisors, thank you so much, as always, for being with us and breaking it down. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Isabel Lee. Isabel.
Hi, Lisa. Recapping the data we just got, jobless claims coming in at 226,000 last week, down from the prior number, but slightly above estimates of 225,000. continuing claims rising from the previous week, coming in above estimates at the 1.81 million. And a private credit fund managed by Oaktree telling shareholders that the redemption requests dropped by nearly half in the second quarter, falling within the 5% limit, allowing the fund to fully satisfy demand. Oaktree is the first major firm to stem a growing exodus from the $1.8 trillion industry. And traders betting on a Fed rate hike as soon as next month after Fed Chair Kevin Warsh's first meeting. President Trump reacting to the news.
It's all right. Whatever.
And it looks like they might even raise them later this year if Duck's there. Do you have any comment?
It could happen. I mean, it's hard to believe. It just keeps the country down, so it's so unusual. But we have a very good guy over there now, so I'm guided by what he wants.
Warsh saying the central bank won't tolerate high inflation. That's your Bloomberg Brief. Lisa?
Thank you so much. And thank you for this morning, Isabel. Up next, Jessica Noviskis of Marquette Associates on the downside risks to the equity rally. And Vonnie Quinn with your morning movers. SpaceX shares extending declines following its first negative trading session. Still, however, up about 40% since the IPO. From New York City, this is Bloomberg Surveillance. Good morning.
The thing that really surprised me is how hawkish that Warsh came across. If the Fed were in a position where they had to raise rates, it'd be a quarter, 50 basis points. The bond market might actually rally on that.
That was at Yardeni of Yardeni Research. And guess what? That's exactly what you're seeing this morning, at least at the long end of the yield curve. You can see enthusiasm in equity markets as oil prices fall, an agreement reached between the U.S. and Iran, even if it's only for 60 days. You can see that really giving a lift to the Russell 2000 futures up 1.25%, and the NASDAQ up 1.6%. In the bond space, that yield curve flattening, really engaging, and you can see two-year yields at least before we got the jobless claims inflecting upward, now down along with the rest of the curve, but 7 basis point decline at the 30-year end, 3.86%. And take a look at that 2s10s curve. You can see it at the narrowest level going back to March of 2025 as people expect near-term hawkishness to lead to stability in the long end of rates. That is what a lot of people are banking on going forward. Less than an hour from the cash open, here are your morning movers with Vonnie Quinn. Vonnie.
Lisa, we're going to start with an upgrade from Barclays we're actually going to start with SpaceX. So SpaceX, we're keeping an eye on this. Obviously, we lost ground yesterday, down 5%. That really just gave back what we had taken the previous day, which was an up 5% day. Obviously, we're still at 185.69. We're a good 40% or so above the IPO price, but we'll be watching the volatility of the trade today. Yesterday, at one point, we were down as much as 7% and up as much as 4%. All right, let's move to elsewhere in the technology sector. So you have now the semiconductors and specifically the memory chip makers higher today. Marvell Technologies, the most profitable among them at the moment. This is because Tim Cook gave the Wall Street Journal an interview in which he said that he was going to raise prices. Finally, Apple products are going to be higher because it's just unsustainable to raise memory, to continue to pay the prices that memory chip makers are asking. And finally, consumers are going to pass it on. Now, that's good for margins for memory chip makers. And then finally, here is the upgrade. Enphase Energy up almost 6%. Barclays upgrading, but it's come on the back of a few upgrades this week. And that's because Enphase is also moving into the AI space. It's not doing so well in the residential sector anymore. China has eaten our lunch when it comes to energy technology residentially. So now it is moving into the data center and it has started shipping products already. Lisa.
Thank you so much, Vonnie. And have a wonderful weekend. Counting down to the opening bell. Here's a trading diary for the week ahead. 11 a.m., Vice President J.D. Vance speaking from the White House. Want to get to that in just a second. Friday, U.S. markets closed for the Juneteenth holiday, which is why today feels like a Friday, at least here in the United States. Tuesday, we get PMI data. Really interesting to see that kind of momentum in the economy. And Thursday, PCE data. How much does that have an added push given the focus on inflation at the Federal Reserve? 11 a.m. What's going to be that? What's that going to be about?
So this was just added to the White House briefing schedule. And, he's set to go to Switzerland to meet with the Iranian counterparts. Obviously, the president signed the MOU yesterday, but I imagine he's going to walk through with the press exactly what's in this MOU, given the fact that the Iranians have already released it. Maybe we'll get an update on those sanction waivers we're supposed to get of this administration, according to the MOU, and how many vessels they see, or what is going to be the procedure. Remember the Chevron CEO saying you really have to map out who gets to go first and how this all is going to operate to give confidence to these ship vessels and ship owners and the insurance companies to allow those ships to traverse the Strait of Hormuz.
Yeah, the details matter. And ultimately, we might get some details at 11 a.m. this morning. Counting down to the market open, stocks rebounding. Jessica Noviskis of Marquette Associates writing, earnings strength is clearly part of what's driving markets. The market assumes the strength continues unabated. That sets a really high bar and creates more risk to the downside. Jessica joins us now for more. Jessica, thank you for being with us. Are you bearish? Because we haven't met a bear in a long time. I just want to flesh that out from the top.
I would not consider myself a bear, but I will say when no one else is concerned about the risks, that makes me feel a little bit more concerned about the risks. I think one of the things that's really telling, so we obviously had a good earnings season, earnings strength is obvious, but the 2027 estimates have increased more than the 2026 estimates year to date. So this was not, right, one quarter, a couple quarters of strength. The market really is assuming that this continues for at least the next 2 years, maybe perpetually with the AI secular themes. And that, right, that doesn't leave a lot of room for hiccups or stocks getting over their skis. And it's that sort of thing that can maybe lead to that market crack. And then who knows what happens in a world where leverage and options are more prevalent than they've ever been.
We were talking to George Concalves yesterday, and he was talking about the year of the bond market, or the summer of the bond market, and how he thinks actually this is a good time to start going into duration. Would you agree with that? This was even before the Fed meeting. Would you agree with that as an alternative in the case that earnings don't keep up?
I think that can be part of the strategy, and especially what the Fed outlined yesterday. I think we could certainly see more volatility in shorter end rates and less volatility in longer end rates. So I think that's probably a good strategy, though I'm an equity girl, and I think equity earnings will always drive the market. It doesn't mean that, there won't be risks or hiccups or volatility, but I think the earnings trends are real. I just worry that we're not leaving any room for any mistakes.
When it comes to the rotation trade, I guess what's going to help it is the fact that we do have this 60-day extension of a ceasefire. Hopefully vessels will be moving to the Strait of Hormuz. But then at the same time, the Federal Reserve is talking about, or leaning towards, at least at the moment, a hike. So how do you deal with the two?
Yes, and I know a lot of folks have talked about the war is, right, essentially over, at least the market's looking past it. So let's go back to the playbook that was working at the beginning of the year. But I think this situation is very, very different from that at the beginning of the year. It was very strong expectations for cyclical strength that included rate cuts, that included tax refunds, which now have been eaten up by higher gasoline prices. That included, I think, an expectation of fiscal stimulus going into the midterms. The focus, right, we had a lot of headlines coming out that were very focused on affordability and the consumer experience, which is sort of the playbook going into a midterm election. And now time has sort of run out of that. The months that have been consumed by the war have left little time for new stimulus measures. Now, we could still see headlines, but in terms of real impact, real things that could help the consumer from here, I'm more skeptical there.
Are you expecting those things to happen before the midterm election that could be potentially a stimulant, not just the consumer, but to the market?
I think the Republicans are incentivized to try, right? We know the war has been pretty unfavorable with folks. We don't like higher gasoline prices. They're coming down now. But the 60 days and the straight partially opening isn't really enough to solve this whole problem. So I think it depends on how the next few months play out. But there's strong historical precedent for the president's party to lose seats in the midterms, and they don't have a lot of cushion for that. So I would expect them to do everything they can.
Jessica Noviskis of Marquette Associates, thank you so much for being with us. Have a wonderful weekend. And right now, ahead of the open, we are looking at a bullish sentiment, really helped by Intel shares. I mean, it's important to note this is a market of stocks, not just a stock market. And some of these stocks have been outperforming in different pockets, driving the tech trade. Intel shares up 8.4%. As Trump gets involved, and there is a deal right now with Apple, again, emphasizing this focus on domestic resilience.
Trump gets involved again in Intel. And in this latest post, he's talking about this work that Apple and Intel can do together when it comes to chips. It also comes at a time when the Wall Street Journal has this report of an interview with Apple, and they're talking about how they're going to have to raise prices because of just the extraordinary, insatiable demand we are seeing when it comes to semiconductors.
The inflation from the AI trade making its way into the other story of the moment, which is the economy and inflation. How much can those two come together? We are seeing the beginnings of that in some of these share prices to watch. Heading into the open, we are seeing that resilience in equity markets continue. It is led not only by Intel, but in general by chip sector stocks, as well as what we see in the memory sector space. This really has been the one high beta trade, although this time coming along with the Russell 2000, given the fact that oil prices really, once again, setting the tone.
They're off to the races lower. This is great news for the White House and the consumer. Devil, though, in the details. A lot of vessels are trapped. Do the insurance company, do the ship owners, do they have the confidence now to go through the Strait of Hormuz? The next 60 days is going to be critical.
Well, the next 3 hours are also going to be critical for all you Knicks fans out there. Enjoy the parade. Have a great time. It has been quite the crowd gathering. Coming up next Monday, Lori Calvasina of RBC, Nouriel Rubini of Hudson Bay Capital, Seema Shah of Principal Asset Management, and Amy Gower of Morgan Stanley. Yes, we can get that mug in the shot.
It's iconic. It's an iconic day for New York.
Oof, oof. Have a great weekend. Take care.